We're growing above trend. We're certainly seeing surprising resilience in many, many areas. And, that resilience may continue.
I do think the strength may persist into the next year.
As we look out 3 years, we will have seen peak inflation. We will have seen peak Fed.
This pause period has continued to be moved out.
We do think there is quite a bit of fragmentation in the economy right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The first back-to-back gains on the S&P 500 of the month so far, which tells you a little something about the month of August. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Ferro, together again this morning with Katie Lyons. Your equity market positive by 0.1% on the S&P. TK Jobs Week begins right now. It starts a little bit later with job openings in America.
Well, it starts with the JOLTS survey, and then we go on to the usual ballet Thursday claims and on to the jobs report. But far more, we have housing data as well. We forget Case Shiller's a little grim. Well, you know what? We're going to get that measurement. I mean, it's not like China where the government's going tick by tick, headline by headline, but I got a quiescent data screen that I think is deceptive, and it's good to start strong with Chris Verone.
I saw the headline across the Bloomberg, Tom, on China, the prospect of cutting mortgage rates. Can you imagine? Can you imagine that happening here stateside, cutting mortgage rates? I think a lot of people who want to buy a house crying out loud for that one right now.
There's a real desperation over there, and I got to admit I'm constructive that they work it out like they have every time for the last 30 years back to Deng. But over here, it's about the economic data, and we forget in the dregs of August where you can't get the clothes you have to have opening day.
What are you talking about? You're talking about back to school. It's back
August.
to school. We're doing back to school.
Everything's sold out. I don't have nothing to wear opening day.
You started late.
First day of school. Of course you started late. It's America.
Okay. That's what we do. We start late in America.
We start late in America.
I'm still holding on to summer.
Yeah.
When the weather's good in September, as far as I'm concerned, that's still summer. If you go through things piece by piece in China, just another headline full of news on my Bloomberg terminal right now. You've got mortgage rates potentially being cut, Katie Lyons. You've got the biggest state-owned banks considering lowering deposit rates for the third time in a year. You've got the Chinese finance minister talking up strengthening fiscal support. What isn't there to talk about in China this morning?
Well, the thing is, we're talking about them all separately. Piece by piece is the right characterization. This is piecemeal policy work that they are doing to try to shore things up. Just the latest line, of course, is on these mortgages for first homes only, but that is the bulk of the $5.3 trillion mortgages outstanding in China, something like 80 to 90% as of the latest data we have. So clearly trying to shore up growth in this economy. The question is, if they're doing it piece by piece, nothing seems to be a full bazooka. Is it going to do anything?
Is it going to do anything, Tom? It hasn't done anything to this market, has it?
No,
that was the real test yesterday.
The data. I mean,
Kelly was on top of that. We had a 5% move yesterday off the back of
I got a tie that matches
limiting IPOs. Have you matched today? Is that what you've done?
We're matchy.
Okay, let's return back to the market.
This is our UVA
TK,
look.
3 minutes in, focus.
I'm focusing. China.
Cutting stamp duty, limiting IPOs, asking some funds to come in and buy the market. Don't sell too much. It hasn't done enough.
I'm going to go to renminbi, 7.29 on yuan. I think the market data in commodities, iron ore and such, is not the panic that you see coming out of their domestic affairs. And there's a separation of China as exporter, manufacturing machine. We all know the ballet. Versus their domestic challenges, which is their 30-year experiment to quote-unquote boost consumption. Guess what? It hasn't worked.
For the record, your bow tie is a mess. It is a mess.
No, it is. Well, so is the UVA
mess.
Football. So,
right, you should fix. I don't know what that is this morning.
No, Lagarde tied this.
What is that?
There's like a sagging side.
Lagarde wanted me to wear this tie.
Is that a new one?
No, it's ancient.
Okay.
Like me. No, but it goes with Kaylee. It's a look. It's a Cavaliers.
Okay.
The Cavaliers.
Very glad we could coordinate this morning.
I did not get the memo. Let's get to the price section. Equity market with the lift here on the S&P 500. I mentioned it, the first back-to-back gains on the S&P 500 for the month so far. It's been that bad in August. Could be the worst month of the year, depending on how we close up a little bit later this week. Futures up in the bond market, yields a little bit lower, down about a basis point here, Kaylee. Your yield on a 10-year, 419.42.
Yeah, and of course, yesterday you saw that 2-year and 5-year auction, the highest levels in yields we've seen since before the financial crisis, talking 2006, 2008. So it really speaks to the pressure we have seen in this bond market. What clues will the bond market take later on today from the economic data we are going to get? You guys talked about it already, JOLTS at 10 a.m. We are expecting 9.5 million job openings. That would be the third month in a row of it essentially staying stagnant. Looking at supply and demand in this labor market, especially after Chairman Powell in Jackson Hole was talking about how the Phillips curve may have steepened, that maybe you're not going to see the labor market deterioration as inflation comes down this time around. Then at 10 a.m. Eastern time, we also get some consumer confidence data from the Conference Board. We're expecting just a slight tick lower to 116 from 117. But as we've seen prices at the pump climbing, inflationary pressure still sticking around, even if that pace of increase is coming down. How much pressure is that putting on the consumer? And then finally, also at 10 a.m., it's going to be a big hour. An FDIC open meeting. They're expected to propose requiring that banks with $100 billion in assets or more issue enough long-term debt to cover capital losses. This is yet another regulatory response we could see to the bank failures we have seen this year.
In the bank failures, we saw San Francisco's head of supervision is retiring.
I noticed that,
October
yeah.
31st.
I think that folds right into this.
Trying to do that quietly.
It's my tie better while she was
It's a little bit better.
briefing on.
It's a little bit
rebriefed my bow tie.
Keep working on it. Chris Verone with us around the table, partner, head of technical and macro strategy at Strategas, a bad company. Chris, good morning to you.
Great to be here.
Is it time to buy that story in China?
I would say this. I wouldn't be short. Think about how terrible the news flow has been the last 3 or 4 weeks. Probably the most bearish news out of China I've seen since 2008. And what hasn't broken down? Iron ore, Tom, to your point, has not gone down. Copper has not broken down. The Chinese 2-year yield has stopped going down. So I think the price action doesn't reflect the bearishness from the news. As someone who tries to marry how does price action versus news interact every day, it would be difficult for me to be here short and comfortable with that when I've gotten every piece of information in the direction of the bears and price won't break lower. So I think at a minimum, cover your shorts and open your imagination to the idea that something might be changing there.
Chris, you and I are trend-based analysis. There's a stochastic catching a knife in the dark and getting on a trend, staying on a trend. The trend you're most interested in is oil. I link oil demand directly to a Pacific Rim recovery. Am I right to do that?
I think we can link it to a number of inputs, that certainly being one of them. Limited supply. I think the supply side of this is equally as important. But at the end of the day, we've had this just bearish onslaught of Russia news and of China news. And what hasn't gone down is crude. Crude's bottomed. It's positive in our trend work. I think Brent's on its way to 90 here. Look how the energy stocks, after a pretty meaningful consolidation or pause this year, have just regained the flag of leadership. When I look sector by sector, there's not another group that has, say, 90% of issues above the 200-day that has relative leadership inflecting again. That's the energy sector.
What does Exxon do? Just as one example, what does XOM do? I mean, basically, it hasn't gone down. As oil went from 120 to 70, whatever, back up to 80 as well. Is oil catching up to the equity stocks, or do the oil stocks surge ahead of a recovering oil?
You know, Tom, I think one of the things we try to do in our work is understand the regime we're in, and therefore we know what rules to play by. I think for so many years, every single rally in crude was one you could sell. Every time the energy stocks bounced, you should sell them. This is a different regime. We've had 6 months of a benign consolidation in energy, and now it's reasserting itself. To the point on Exxon, what I'm encouraged by is a lot of the return to leadership from energy has come without the major integrators doing a whole heck of a lot here. This has been the service names. This has been the E&P names. Look at some of the big global names here as well, which have all really reignited in terms of a leadership story.
Okay, what about elsewhere in cyclicals, financial stocks in particular? I know you're looking at some of the banks. We were just talking about how we're continuing to see the ramifications of the failures we have seen this year. What's happening in those guys?
I think if you told me that the bank index would be down 15% year to date, I wouldn't guess the S&P would be up 15% year to date. We went back yesterday and looked at every major S&P low over the last 100 years. This would be the first time in 100 years where you're nearly a year off the low last October, where S&P is up some number and banks are actually down. It would be more normal if banks were up 70% here. They're down 15 from where they were last October. You go name by name. It's just odd to me that Citigroup is back on the lows, Bank of America is right there, Goldman and Morgan Stanley look weak, and we know the regionals have rolled. I think it's difficult to entirely dismiss that. I think the benign explanation is, listen, 50% of the S&P is above the 200, 50% is below. It's a very, very split tape. What I don't like is on the wrong side of the split tape, you have some pretty important groups like banks.
So if you're saying we're too pessimistic on China, are we too constructive on the United States?
Yeah, I think we're probably too constructive on Europe, which I think is deteriorating right now. Like, look at 3-month low German DAX, 3-month low French CAC. And, what drove a lot of those markets were European luxury names. Those have all rolled here. European discretionary has rolled. So, in a way, go back 14, 15 months ago, Europe was kind of first to bottom, turn up and lead. That seems to be flagging here. So I think before you talk about U.S. at major risk, I think there's a change going on in Europe. You see it in Euro-USD cross as well, which has come in sharply as U.S.-German rate differentials have changed.
So what am I positioning for? Dollar strength? What are you looking for? Where are you positioned to take advantage of that?
What's funny is I think it's interesting how consensus short dollar is, yet dollar's really not going down almost against anything I pair it against. In a way, Tom, it actually makes energy's resilience here even more noted, that it's happened even as dollar has firmed. But dollar's firm against yen. It's firm against euro, it's firm against sterling, it's firm against CNH. So hard for me to really embrace the short dollar call when it's just not on the charts.
I'm looking at BBDXY, which is a blended bank index, which includes a lot of emerging market in China as well. And to be kind, it's well-behaved and center trend on the trading envelope, 2 standard deviations as well. You suggest that breaks stronger?
I think if you look pair by pair, it's hard to come up with a really compelling short dollar call here. Even like Aussie USD, right? That's been soft. I think the pair you ought to focus on here is actually Euro CNH. Euro has been so strong versus CNH for the better part of the last year. That actually seems to be changing here. And I think it's in step with this idea that something's changing with China. Perhaps a stronger CNH relative to Euro is one more sign in that direction.
You've got a call for Lagarde next month. September 14th.
When I look at, say, German rates as kind of our barometer here, they've effectively been in this range for the last 6 or 7 months. My experience in this business is always surprises break in the direction of the trend. And I think the trend in global rates is still up. So I think if there's a surprise, it's rates have one more last push in them. That would be our guess.
Chris, this was awesome. Thank you, buddy.
Thank you.
Thank you. Chris Ferro, a strategist there. If you want a call on the FX market, Goldman Sachs out with the call on the FX market. 6-month call, dollar yen. They were looking for 135, TK. They're now looking for 155 on dollar yen. They're going back to the 1990s on the Japanese yen. Governor
Ueda had the chance to clear the air at Jackson Hole. From what I can tell, he did not. There's a huge uncertainty there. And here, what you said, John, 135, and the Goldman Sachs calls what?
They're looking for 155. The call wants 135.
147 right now, and I would say Kitchukes and others are really heightened here at 147, 148. I don't know where you break through 150, but I'm sorry, the Bank of Japan, the Ministry of Finance, will defend the yen on the path to 155.
You've got a level in mind there, Chris, for when that happens for the BOJ.
Higher.
Higher. How much higher?
Weaker yen.
I'm drawn to the 55 number. It's an important Fibonacci number, actually, if you look at kind of the long-term dollar-yen chart. But you kind of can't have it both ways. You're either going to defend the bond market or you're going to defend the yen, and I don't think you can do both. The big winner, though, I think, is domestic Japanese assets. If they're doing everything they can to keep money at home, I think Japanese bank stocks reflect that. They're the strongest bank stocks anywhere in the world. I don't think that's an accident.
Chris Ferro, got to thank him twice. Should have stayed on Japan, Tom, just a little bit longer.
Yeah, well, I think there's a huge opportunity there, and it's unplayed in the Western media. No question about it.
Microphone, TK, just a little closer.
Yeah, it's over here.
Okay. Coming up in the next hour, Michael O'Rourke, Chief Market Strategist at Jones Trading. Looking forward to catching up with him. In your equity market right now on the S&P 500, elevated by 0.1%. Back-to-back gains for the month of August, the first time in yesterday's session, off the back of gains on Friday. Jobs week begins right now, or rather begins a little bit later with job openings in America. Then it's on to ADP tomorrow, jobless claims, and on to payrolls on Friday. From New York City this morning, good morning.
We agreed to establish a new commercial issues working group, a formal working group, which will involve U.S. and Chinese government officials, and very importantly, U.S. and Chinese commercial private sector representatives as we seek solutions on trade and investment issues and to advance U.S. commercial interests in China.
That was US Commerce Secretary Gina Raimondo speaking yesterday at a reception during her first day visiting Beijing. The first day of 4. That meeting going through Thursday for the Commerce Secretary. Plenty of news out there from China over the weekend. You know the rhythm of things by now. Easing, trying to support the economy and financial markets. They cut stamp duty on stock purchases for the first time since 2008. They've limited IPOs. They've been leaning on some funds to buy more than they sell. This morning, Tom, we're talking about maybe cutting the rates on deposits to try and juice this economy too. It's just attempt after attempt, day after day, week after week.
So full press by Gina Raimondo, our Secretary of Commerce there as well, Elizabeth Economy with the Council on Foreign Relations. And also our Ambassador Nicholas Burns has been doing a very quiet, steadfast job under a lot of tension over there. But is this a lame duck trip? If I'm the Chinese, am I just like, okay, we'll take this in, but are we getting to the point where they have to wait for the election?
Based, Tom, on the amount of visits that are taking place by this administration to Beijing, based on those actions, it's pretty clear the objective is to maintain a relationship with China. And I'm sure they want some of these issues domestically resolved in an orderly fashion. Domestically, what they do on the campaign trail is totally different. And I think we know that based on the reporting of what President Biden said to potential donors when he said that this economy was a ticking time bomb, referred to the leadership and some of the individuals, the officials in the party as bad folks, and then going even further and saying when things get tough, Tom, bad folks do bad things. Now, if I was Chinese official right now, they're the kind of questions that I'd be asking of the Commerce Secretary. What kind of bad things do you think we're going to do?
And the other thing is I don't see specific negotiations on specific trade ideas, which is, of course, Raimondo's territory. But I get the visibility, John, and the imagery. I'm just not sure where we're going with this.
Well, where we're going is that they're trying to maintain a relationship without aggravating Beijing too much as they try to protect national security interests. This is what we have heard Raimondo and all of the other officials who have traveled to Beijing say. This is about national security. You are not trying to hold China back economically. And even Raimondo yesterday was saying that the U.S.'s aim here is not to decouple. They've had to switch language from decouple to de-risk.
To diversify.
To diversify. They've had to be so careful with how they navigate it, also knowing how sensitive the U.S. economy will be to any kind of slowdown we see in the Chinese economy. And you can't push it too far that you get caught up in the ripple effect afterward.
That's a tough enough needle to thread, Kaylee. On top of that, then you've got to be hard on them at the same time simultaneously, TK, because that plays well domestically going into an election year. That's the challenge, to your point.
And that's the election year ballet here, and there's a domestic play. But I just don't see much getting done here other than photo moments, video moments as well. Let's get some brief on this on the Pacific Rim and also, of course, on the dollar. Win Thin is global head currency strategy, Brown Brothers Harriman, out of his Burma with a real visceral understanding of the Pacific Rim. If you are resilient dollar, Dr. Thin, what does it mean for the Pacific Rim? Can you imagine renminbi 7.29 yuan, dare I say a 740 or 750? Is that possible?
Absolutely, Tom. I think with the easing measures still being rolled out day by day, the interest rate differentials between the U.S. and China continue to move in the dollar's way. So yes, we're going to revisit those highs from October back around 7.33, I believe. And I can't rule out something close to 7.5. I know it's sort of maybe premature, but at this point, I haven't used this term so many times in a long time, but they're really pushing on the string here with all these measures. And the last time I used this term so many times was back in the early 1990s, referring to Japan. And obviously the parallels are there. They are falling into a deflationary trap, a huge debt overhang. And these little measures that they're rolling out just aren't going to do it. They can't grow the way out of it. They're not growing 8, 9, 10% anymore. So some day of reckoning is coming. And I don't know when, but it will be coming.
Well, with your work at Columbia, you've been a great student of their international relations. Is this where a totalitarian regime essentially capitulates and changes direction politically?
Well, Tom, the policymakers in China have kind of tried to do it, both ways. They've tried to open up economically while limiting political freedoms, and that's been sort of the unsaid bargain between the policymakers in Beijing and the populace. But what's changed really over the last several years is that the economic prosperity is no longer being delivered We know that there's youth unemployment is somewhere upwards of 20%. They stopped publishing that number. But there is a delicate balancing act that the policymakers are really trying to pull. They know they can't sort of grow the way out by issuing more debt, because that would just add the problem. So to me, the end game is something I see akin to what we saw in Japan, is that's huge debt restructuring, haircuts, bailouts. I mean, it's very painful. It can be done. I don't think it's ever been done on this scale before. And it's going to be, make no mistake, it's going to be very, very painful. But I think that's going to be happening in sometime in the next few years.
Well, what we're seeing just within the last few days, is piecemeal action from China. Reports that they're looking for Chinese state-owned banks to cut deposit rates for the third time in a year, potentially cutting rates on existing mortgages as soon as today. John already mentioned the IPO restrictions they're looking at putting into place, asking entities to buy more than they are selling. It's just one thing after another, but does it all add up to enough? What more realistically can China do here to shore things up?
Well, they're doing what they can. But again, with debt to GDP around 300%, they just can't go back to the old way of rolling out huge debt-fueled stimulus. Again, they're pushing on a string at this point. That at the margin, all these things may add up to a little bit of support, but really they're tackling the symptoms rather than the root cause, which I think is this huge debt overhang, overextended property sector that's feeding into the financial sector, right? That's where this whole thing sort of kind of comes unraveled, is when the property sector stresses feed into the financial sector stresses. Again, I'm not trying to be like a doomsayer, but it's hard for me to figure out how they get out of this without a really painful sort of restructuring. And again, because it's so painful, they're going to put it off as long as they possible. No one wants to do this. And so they will continue to roll out these piecemeal measures until it becomes just too much to bear.
Well, and that's all.
Yeah, I'm sorry. Go ahead.
That's all addressing the domestic problems. But what about the problems that more relate to the rest of the world in terms of exports, in terms of trade? And as we are talking about de-risking, diversifying, decoupling, whatever it may be, trying to get supply chains out of China, the trade flows around the world changing as well. On a longer term view, ultimately, what will that mean for the Chinese economy?
Well, even before these latest problems in the domestic, the President Xi had been trying to promote more domestic activity, more domestic consumption, and had really sort of taken their eye off the external sector. Part of it was, I think, due also to the U.S. measures under former President Trump with the trade wars, et cetera. And so it sort of came at the worst time. That he switched to a more domestic-led strategy at the time when the domestic economy was really about to come under some serious stresses. Obviously, COVID had added to the pressures as well. So can they switch gears and go back to sort of an export-led recovery? It's not going to be that easy. The flip side of the coin is that most of its major trading partners, for instance, obviously the U.S., they've changed their supply chains already over the last several years, become less dependent on China. We saw that imports from Canada and Mexico have now overtaken those from China for the first time in decades. So it's not going to be that easy for China to sort of just flip a switch. I do think that President Xi will continue to sort of focus on this domestic-led recovery. And remember, think about the global growth outlook, because it's quite poor right now. So all these things to me point to a sort of a doubling down on this domestic-led focus, but unfortunately will lead to some sort of crisis in the coming years.
Win-Thin, thank you, sir. Win-Thin of Brown Brothers Harriman on China. The latest quote from Kit Jukes over at SocGen on China. I shared this with you yesterday. I think it's worth sharing again. Both Christine Lagarde and Jay Powell made it clear at Jackson Hole that they intend to see out the fight against inflation. There will be no changing of targets and no premature easing. But the earworm that I can't keep out is Mike Tyson's "everyone has a plan till they get punched in the mouth." Yep. And the headline of that piece yesterday, Tom, "Everything will be fine unless China punches us in the face."
There'll be others. I agree the mass here is China, but I'd also look at, say, South African rand through 20, pick any other currency pair, as Christopher Owenwood as well. I totally take the point. There's a point where, you know what? Facts change, I change.
Equity futures right now on the S&P, just about positive on the S&P 500. Veronica Clark, economist at Citi, on why this Federal Reserve ain't done. That conversation up next. Stocks are just about positive on the S&P 500 this Tuesday morning. We are elevated by not even 0.1%. Two-day winning streak, the longest of the month on the S&P 500, speaking to just how bad this month has been. The fact the S&P 500 is down about 3.4% in August, and that's the worst month of the year, speaks to how good 2023 has been.
It's not a correction. It's not even close. This is just noise. You have to look at the ginormous move we've had since October of last year.
That's what I just said.
I know, but
I didn't hear correction anywhere in there.
3%. I don't mean you, John, but I mean out in the zeitgeist, people are thinking it's a crisis, it's a meltdown, it's a markdown.
Does it have the ingredients for one?
I think people are just trying to keep busy. No, I don't agree. We're down 4%. I got a VIX at 15.11 and I'm stressed. That's a victory lap VIX.
Let's get to the bond market, Tom.
Please.
I'll do this as calmly and as chilled and laid back as I possibly can.
Real yield's better.
Your 2-year at a beautiful 5%. Imagine the wonderful things you could do with that 5% yield. A 10-year, Tom, at 4.2079. Yield's going absolutely nowhere, but that's okay. Things are fine. Is this helping?
It is. I mean, I got a triple leverage 13-month CD. You're doing pretty well.
A yield we haven't seen for a couple of decades. It's a beautiful thing. 4.2860. And if you want a mortgage out there right now, TK, don't worry. I'll get you one with a 7 handle. And you're going to be totally fine.
Charles Bailolo with out there with the housing value, because rates have gone up. John, you've been great about this. How about this? In his calculations with Redfin, $641,000 is what you were buying X amount of months ago. Now you're buying $434,000. That's the reality. And imagine that taken over to rents.
It's
just like you go from a 4-bedroom to a 1.5-bedroom.
Tom, I said it yesterday. It's worth repeating. The distortions you're going to see in the economy.
Yeah.
Based on the rate policy of the last couple of years. Have we ever seen, in the space of 2 years, Tom, record low interest rates and then the highest rate you've seen in 2 decades?
Well, this is the distortion.
In the space of 2 years.
Yes, I agree.
This is why this mortgage market's so screwed up.
It is, and we'll get the data today, Case Scheller, and it's a little bit delayed. It's not like the more recent data, but I agree with you. Off the pandemic, the proper phrase is it's screwed up.
Going to turn to the FX market.
Please, let's go.
Nice and calmly. This is a new tone, Tom. It's a new mood for the FX market. 108 on euro dollar.
We go to 4 digits, 108.
108.12. Okay. Dollar yen 146.64. Does this work for you?
It does. I'm just
it's
feeling
like bedtime reading.
It's peaceful.
Dollar yen, the call from Goldman, 155. TK, taking it back to the 1990s.
Like to order a 16-year-old to read the Scarlet Letter at gunpoint.
Where's this going?
You will read Nathaniel Hawthorne in the next 7 days.
Are you trying to explain your mood this morning?
My mood is based on...
The youngest isn't doing the homework.
Scarlet Letter. It's a rite of passage in America. It's about British people north of Boston.
All right. Good book?
That's open to interpretation by 16-year-olds.
Did they make a movie?
They've had many movies.
Oh, very cool. Yeah. Well, why didn't you just watch the movie?
No, you read the Cliff Notes.
And then you watch the movie and
Cliff
pretend to have
Notes
read
are
the
little
book.
yellow and black notes that you read on your way to class.
Okay.
Okay.
All right.
Oh, you know what I'm talking about, right? Kaylee Lyons.
I did all of my reading, Tom.
Stay with us, Tom.
Yeah.
Under surveillance this morning. Don't know where this is going. China officials vowing to strengthen policy support and speed up government spending in order to boost the economy. According to reports, the officials calling the foundation for a sustainable recovery not solid, adding the current environment is, quote, full of uncertainties. Katie, they're basically saying it all out loud, aren't they? Just how difficult things are right now.
Yeah, and this is what we've heard from Chris Verone and Within this morning. China is doing what it can. I guess the question is it doing all it can to try to shore up growth in this economy as you're seeing fragilities in so many different places?
Don't see those fragilities stateside. Going to get a week full of jobs data. It starts at 10 a.m. Eastern time. Data expected to show job openings holding steady at around 9.5 million, down slightly from last month's 9.58 million job openings. TK, this week it's all about whether we're making that progress, more progress, around just taking some of the heat out of this labour market.
Taking the heat out, and we're under 4% unemployment rate as well. I get there, but I'm sorry. Elizabeth Warren has something to say that I think conservatives and liberals agree with. Why are we cheering for unemployment? I'm in my textbooks, I'm just not there.
Chairman Powell a year ago, what did he say in Jackson Hole?
Pain.
It's the pain. It's the pain, Tom, that's required to avoid the greater pain of inflation staying around too long. Which is easier to say when it's not your job on the line.
All I know
which has always been my frustration with the central banks that say those things.
My basic take is McKee says JOLTS is important. That's all I know.
So look out for job openings a little bit later. Here's a story that I think should be on the radar big time. Workers at Chevron's LNG plants in Australia planning to strike. The work stoppage is expected to last up to 11 hours a day from September 7th to September 13th. That's all according to people familiar with the matter. But the fact of the matter is, Kayleigh, off the back of this story over the last couple of weeks or so, the threat of strikes in Australia, shaking up the gas market in Europe, which just goes to show how fragile that market is right now.
Yeah, and how energy pressures could feed through to other inflationary pressures in the European economy, creating a very difficult proposition for Christine Lagarde and others at the ECB. And as we're talking about energy prices also on the rise here in the U.S. in the form of just prices at the pump, the ramifications potentially for the inflation picture could be quite large.
I have to admit, going out to Wyoming, you get a real understanding of prices at the pump. People there drive 60 miles like it's to get a quart of milk or whatever. You forget living in Manhattan. What I think is important about Australia is the sprawl of big oil there. This is Barrow Island, the Gorgon pipeline. This is 35, 50 miles, whatever, off Western Australia, sort of off at 10 o'clock on the clock of Australia. It's good geography there.
This is working. Keep going.
It's great. I mean, the Australian LNG unions, they want more money, more time, safer conditions, and they want more Swan lager.
They want more lager.
They want
That's
more
the
Swan
punchline.
lager. It's Western Australia. They
Perth.
bring it up from Perth.
Yeah,
none of that Melbourne stuff.
Good to know.
I'm getting my pronunciations
I think
down.
we're done with this segment now.
I think we are.
Wonderful.
Let us continue right now, and this is an important interview of the day, particularly if you're framing out higher interest rates. Veronica Clark joins us, economist at Citigroup. Veronica, let me cut to the chase. Do you and Andrew Hollenhorst recommit to a path to higher interest rates?
Yeah, we do. I mean, we are still expecting one last rate hike. I mean, I don't know if that will take rates, too much higher, just 25 basis points. But we are expecting that the Fed's going to follow through on that last hike. That's what's in the June dots. I think that dot probably stays there in September, but then we get the hike in November. But one more to go. Yeah, still a bit higher rates.
What will it do to the American economy? There can be an ambiguity that high rates signal vibrancy, which is an economy that gets used to those rates. Do you buy that benevolent story?
Yeah, I mean, we would have thought that the economy would be more reactive to an already pretty high level of rates. Of course, another 25 basis points necessarily isn't really going to do much to that. I think at some point, as businesses and households do reset into higher borrowing costs, you will feel that bite of higher rates. But I think everyone's been surprised that we've been so resilient up until this point. Yeah.
Are we going to start to see more signs of the bite kicking in the labor market, though, Veronica? What are you expecting to see from the data starting today and through the remainder of the week?
Yeah, I don't know if we'll really see that quite yet. We're actually forecasting an employment report on Friday that probably looks like the Fed's ideal slowing of the labor market. We're thinking 130 jobs, a bit softer wage growth, 0.2 average hourly earnings, and that could look pretty ideal. But there are some distortions, I think, in some of this data potentially related to, we have a strike of Hollywood actors that might be showing up. It's just been amazing that, jobless claims are still so low. We still have around 9.5 million job openings. That's about 2.5 million higher than pre-pandemic. It is still a very strong, tight labor market.
Well, Veronica, you mentioned a strike that is ongoing out in Hollywood related to the actors and writers. There is also a strike that could be to come just a couple weeks from now if there's no new deal for the United Auto Workers, who have asked for a 46% increase in their compensation. How should we be thinking about the union activity we are seeing, the strength, it seems, of the labor movement, and ultimately what that is going to mean in terms of wage pressures that the Fed is going to have to contend with?
Yeah, I mean, all of these strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages. So even if we saw softer jobs numbers, it could be because of strike effects. It could just be because we are in a tight labor market. We're running out of people to hire. Labor supply is still an issue here.
Veronica, off your remit, but if we get the Hollenhorst-Clark call, what does the 10-year real yield do? Do we break through 2% and go out to, I have one model back to 0506 where you get out to 2.2%. Could we get there?
Yeah, I think you asked me this a couple weeks ago, too, and I will leave it to our race.
I only got like three. Veronica, come on, Veronica, you can't go after my act. I've only got 4 questions.
No, I know. I mean, I do agree with the sentiment that, as long as activity is holding up and we are running inflation that's too high, yeah, you will just have rates higher for longer. And I think that's kind of what Powell was trying to get at in his Jackson Hole speech too, is that we need to have a restrictive level of rates for a while, and that means rates across the curve can stay high.
We're seeing what it does to housing. What does it do to business investment? What does it do to the animal spirit of CFOs?
Yeah, I mean, you would think that, of course, higher rates, manufacturing sector will be sensitive to that. You will see a slowing in investment, but it's actually been pretty incredible. We've seen investment picking up in the last couple of quarters. Some of this is related to, we're working through supply chain issues that meant you couldn't produce cars for a couple of years. There's a new demand for aircraft as travel demand is rebounding. But even other goods, you're starting to see that investment pick up, and that's definitely not what you would expect in a high rate environment.
Veronica, let's just build on the housing market stuff. Have we really thought through what it could look like if a generation in this country is locked out of the housing market in the UK and home ownership in the US more specifically?
Yeah, I mean, it is pretty incredible. It is just pushing a lot of people, to rent for longer, of course. It's interesting when we think about what that means in terms of how we look at inflation. Of course, we have had high rates that meant people don't want to sell their homes. We've had home prices that are rising again because supply is so constrained. And if you are pushing people into renting for longer, it is technically rents that go into inflation measures. So yeah, until you fix that supply side of things, you could have this upward pressure on prices still. And yeah, then people that are not owning homes when they maybe should.
Are we going to get to the point where they start to just ignore the cost of shelter, Veronica, when they start thinking about inflation because of that dynamic? They've totally distorted this mortgage market. It's something we brought up in Jackson Hole last week. Veronica, I just don't see enough coming from the Federal Reserve about the consequences of that. Do you?
Yeah, it is interesting. Powell was asked about it at, I believe, the June press conference, or maybe it was July, about the dynamics that we're starting to see in the housing market with prices picking up again. And he basically said, we're hoping for a supply correction. And that's not exactly the right response you should have after the last couple of years of supply-driven inflation. I mean, I do think that there is a level of rates. And as people reset into higher borrowing costs, there will be downward pressure on demand, downward pressure on prices. It could just take a while. We have 30-year fixed rate mortgages in the U.S.
Well, to your point, it might just take a couple of decades. Veronica Clark there of Citi. Veronica, thank you. That's a difference with the UK, Tom. It might take a while. It might take a couple of years for that to reset. In the US,
I think it's huge
this could take
difference.
a long, long time to work through because of the 30-year fix.
Yeah, a huge difference, and it's maybe floating versus fixed cultures, almost cultures, if you will. But the distortions are tangible, and what I worry about, John, is we love to talk about housing distortions because that's where rich people are, but I would bring it right over to the rental market nationally. West of the Mississippi River, there's some real rent disinflation going on. We haven't seen that yet here.
Well, Tom, I think this is going to be a big feature next year, Kaylee, in the election. We're blowing up the so-called locked out of home ownership. What's the promise now?
Well, this is the question. When you're touting Bidenomics and efforts to get prices down, that isn't necessarily being reflected at what you're seeing in the grocery store, what you're seeing at the pump. And also, if you are in a position where you're trying to find a home, trying to find a place to live, you're faced with extremely high borrowing costs or just extremely high figures, your perception of the health of the economy and your ability to operate within it is going to be skewed perhaps in a negative direction. So the politics of the economy, very much a feature in 2024.
I think we underestimate how few houses are being listed. I look at Zillow and I've got curiosity about different
it's all new builds and they're more expensive.
And there's no little red buttons on whatever geography you go to. It's remarkable on a span of suburban geography how there's zero.
You know what we need? A Citadel internship. $19,200 a month, $120 an hour. You know what I said about becoming a UPS driver?
Yeah.
Or an American Airlines pilot, coming back as an intern for Citadel in Kenny G.
Yeah, you could do
What do you make of that? That could work.
Got to be one of 69,000 applicants.
I might not have the quant skills to make that happen.
Carry the coffee for Mr. Griffin.
I'll carry coffee.
Can I get your laundry? I'll get you dry cleaning.
I still think there's a little bit of digestion of gains that is in order, but I think that we are going to experience a recovery come the fourth quarter of this year. I don't think that the Fed will be raising rates in September, but we do see the possibility in November. But then our belief is that will be the last one for this cycle.
It's a question a lot of us have asked, just how high is the bar for a hike on September 20th, with payrolls on Friday and CPI on September 13th? That was Sam Stovall, the Chief Investment Strategist at CFRA. And the answer to that question, for many people we ask it to, is very high, very, very high. Your equity market right now, looking at the S&P 500, squeezing a little bit higher by 0.05% off the back of a two-day winning streak on the S&P 500 and on the Nasdaq as well. Yields just about unchanged on a 10-year at 420.40. And in the FX market, Tom, a slightly weaker euro here at 108.10 on that currency pair, negative 0.08%.
I want to re-emphasize, John, in late August, we're supposed to stagger our way to Labor Day. Boy, there's a lot going on in the market. I mean, it's deceptively quiet today versus yesterday. But as you mentioned, for those not keeping score, from Thursday last, boy, have we moved.
There's something about China in the month of August. I'm not sure what it is, but it appears to be a thing. From the FX mess a number of years ago in the last decade. It was August, wasn't it?
We got to work on this. I mean, Meredith is like in charge of this.
What do you want to work on?
Arsenal Tots.
Oh, North London Derby, nice.
I mean, come on, let's be honest here. I mean, this is what matters.
I've reached out to Levy. We'll try and make that happen.
Yeah,
We also became
it's
friends.
at Arsenal, right, though?
It's at the Emirates, yeah.
At the Emirates.
We became friends with the Arsenal CEO as well, so we can try and fix up that too.
Did I spell Arsenal right?
Have you seen the new song, Big Ange?
Oh, yeah, Big Ange. Big Ange is big
awesome
right now.
Song. I'm loving Big Ange instead. If you don't know that song, YouTube it. What is it about the British football fan just coming up with amazing songs?
They're gifted. I mean,
aren't they talented writers?
It's like
they are
Lennon
poets.
McCartney redux.
They are poets.
They're poets. Sometimes drunk, sometimes not. Speaking of not, Damien Sassauer joins us now, Chief Emerging Football Markets Credit Strategist here at Bloomberg. Where's the derby right now in your world? I mean, forget about Argentina, and Georgieva sort of brushed it aside in her conversation with her on fragmentation. But where's the derby right now in the EM world where I can make some money?
Well, you mentioned fragmentation, right? So, I mean, when I look at fragmentation, I have to look at your favorite asset class, your favorite financial instrument, CDS spread. So if you look at China relative to EM, you've seen a massive decoupling. I mean, China CDS, 5-year CDS spreads have blown up, but nearly every major emerging market, their sovereign CDS spread has tightened and tightened significantly. Now, let's be clear. The U.S., downgraded by Fitch, Germany, France, and other developed markets have also seen their CDS spreads widen over the period, but it's this China-EM dislocation which is really grabbing me.
Okay, let's go jargon breath and get this correct. CDS, credit default swaps. China blows out.
The measure of default.
Do you play a better and improving China, or do you short the rest of the crew as they come towards China?
It's the latter, in my opinion. And look, take nothing about it. The China growth miracle is over. What are we talking about? JP Morgan's talking about 4.8% year-over-year growth this year. I think Bloomberg survey just came in at 5.1%. Everyone's talking about the fiscal spend. There is no fiscal spend. China's fiscal deficit has come down by a third over the first half of this year. A third, 33%, to $477 billion. Why, you might ask? It's not public spending. It's spending at the state level because there's no land sales. There's no tax revenues. They cannot spend. And so the deficit is shrinking. And that is really fundamentally what's going on there. And that's why we talk about Evergrande and Country Garden. And most recently, Great Wall, one of the 4 largest distressed asset managers in China, who may also be technically in default because of a covenant breach because they haven't filed their financials, i.e. Huarong. So these are all the issues that I'm kind of focused on here on a sleepy Tuesday morning.
You think this is the real deal?
I thought it was the real deal 5 years ago, 10 years.
Hey,
no, I'm kidding.
But you think this is the real deal now?
I think something. I'm not a win thin like it's imminent, but something is going to give. It has to, right? I mean, look, they just cannot stoke growth, and the dislocations. I mean, if you just look at the divergence in forget about sovereign spreads in carry between yields in China and the U.S. I mean, these yield differentials are just so wide. It's just so easy to fund in China yuan, to fund risk in other asset classes. How long can that game go on until it reverses in on itself? And you mentioned seasonals, and I agree with you. I hate to talk about it, but seasonals matter, and we're entering that historical September-October period, which has not been good for risk assets.
Let's get away from the next couple of months. Are you thinking lost decade, the potential for one?
Japan-style lost decade. I hear what you're saying.
The reason we're having this conversation is because we've had moments like these in China How many times over the last 10 years? And how many Augusts have we done this? And every single time, if you've had faith in the policymaker, that faith has been repaid.
Exactly.
There is a worry that maybe it's different this time. We're thinking about the potential to have those kind of dynamics of a balance sheet recession that we've been fearing for a long, long time. And I'm trying to work out whether this is the real deal, the prospect of that actually happening now.
You know, Jonathan, I don't think you can make that call as a fiduciary, as a portfolio manager. That would just be kind of shooting darts on a board. I think what you have to realize is that China valuations, if you just look at Alibaba, have come down so significantly. And this is a company that's generating a ton of cash flow, a ton of revenue. And I take the Argentina stance to this. I mean, maybe I take the other side of that and say when things are really, really bad and you really don't want to buy, that's the time to buy. I mean, that's the Argentina. That's how people make money in Argentina and Venezuela and emerging markets writ large. I mean, I don't have the stomach for that. That's why I don't manage money. I don't have a P&L anymore. But like maybe that's kind of the way you have to look at China now. You know, 0% is not the right number, but certainly I wouldn't say it's 10 or 15%.
Well, that's kind of what we were hearing from Chris Verone earlier this hour. Not necessarily time to buy, but at least don't be short.
Yeah.
He was saying the fact that you haven't seen a further deterioration.
Don't be short equities, I would say. I would agree with that.
Is maybe a sign that you wouldn't want to bet against this market. But Damien, when we're talking about, and you were talking about JP Morgan now seeing sub 5%, everybody else kind of in the 5% ballpark, China is still growing. It's just not growing as it once was. How great is the risk that that growth story no longer is a growth story?
Well, I mean, the growth miracle is dead. Certainly the 8, 9, 10% growth rates that we've seen in years past are gone. But, you know, and to your point, it can't grow its way out of this mess like it could in years past. I mean, you could think about the big bazooka that's coming. Maybe it will come, maybe it won't. But it just seems the numbers are so large now. I mean, it's such a big economy. Look at the U.S. and the struggles it's had. Look at Japan and the struggles Japan's had. It's just not easy to grow its way out of this mess, especially when you have such a lack of economic transparency.
Since we've last seen you, besides the Jets beating the Giants, the yen 147. We're back
on its
here
way to
in a weaker
155.
yen.
Yeah.
How do you play? How do you speculate on weak yen?
Well, that's an easy one. I mean, you could just basically short the yen. I actually think, though, you know, if you want to look at a proxy for hedging, you know, downside in China growth, Aussie yen is probably your best bet, right? Getting long the yen relative to the Aussie dollar because, you know, Australia and its linkages to China growth. I mean, obviously, notwithstanding, I mean, that has become one of the most liquid ways, I think, to hedge your risk there. There are others, but I think that's probably the one a lot of people are paying most
Mohammed
attention
from
to.
Cambridge says, I don't care about yen and all that. He just wants to know about the Jets. Are
Yes,
the
he
Jets
does.
for real?
Yeah, the Jets are for real. I love the Jets this year. All you getting? Well, look, I mean, at 4 p.m. today, the roster cuts come. So you have to cut a 90-man roster down to 53. There's going to be a lot of people out there who are looking for a new home, and the Jets have some money to spend. So I'd like them to add on the offensive line, maybe another wide receiver, perhaps. But that wide receiver they have, that second year out of OSU, that kid named Garrett Wilson is awesome. He's awesome.
Excitement about the Jets. This is great.
Yeah, it's green. The team's green.
The green?
Green uniform.
And white, right?
Yeah.
Green and white?
Yes. Namath.
Just a little white?
Yeah.
Okay.
They haven't won since Namath.
I saw that Aaron Rodgers might be dating the Bucs owner's daughter. Did you see that?
No, I missed
hey,
that.
Tom, keep up with the news. That's the gossip news.
DailyMail.com, Someone go get Tom People magazine.
You know, Kelly, you're going to have to get John to a college football game. He's been asking me.
I've said it, Kaylee, this year is happening.
He's not going to Tuscaloosa or Athens or Ann Arbor.
Forget the SEC.
Do you know who emailed me last night? The kicker for the University of Virginia Cavaliers.
I've heard this story. He's a Marine.
He's a vet.
Yeah. I got a lovely note from the guy.
Surveillance fan.
Yeah.
And
he sent you a note after you spoke. Really?
Sent me a note. Yeah, lovely note.
See, what an adult.
He's got his head screwed on. Listens to Bloomberg. That's what we like to see.
I love that.
That's what winners do, Damien.
Winning Time. By the way, another thing. Have you been watching Winning Time? I mean, the casting of Magic Johnson, Larry. Have you not been watching that?
I've not seen that.
Oh. Forget it. All right, we won't talk about it.
Where'd you watch
more
that?
about China.
Where's that stream?
I think it's Max.
Okay.
It's so good.
Another one.
The sixth streaming service I have to be signed up for.
Now, I got to assume you have like an 85-inch TV or a 110-inch TV, some ginormous thing.
I mean, well, my
Staten
vision
Island dims when you turn it on.
My vision's not what it used to be, so I do need a bigger picture. Yeah.
Okay.
For sure.
TK's got a tiny TV.
No, he doesn't.
Yeah, it's
like a little TV man.
23-inch TV.
Yeah.
And sits on
got
one of
rid of the
those.
Zenith.
What are those things that you put art canvases on? What are they called? What are those?
Easel.
He puts this little TV on an easel. That's how it's set up.
And well, we got rid of the Zenith a couple years ago with the rabbit ears, and
They're so fashion forward. TVs on easels.
You like my UVA?
It matches.
Okay.
Beautiful. Yeah, you guys match.
Cavaliers were matchy.
And Broncos orange.
And a little Vandy in there, too.
Looks great on radio.
David, thank you, sir. It's good to see you. Thank you very much. Michael O'Rourke, Jones Trading, coming up. Futures unchanged on the S&P 500. Live from New York, this is Bloomberg.
We're growing above trend. We're certainly seeing surprising resilience in many, many areas. And, that resilience may continue.
I do think the strength may persist into the next year.
As we look out 3 years, we will have seen peak inflation. We will have seen peak Fed.
This pause period has continued to be moved out.
We do think there is quite a bit of fragmentation in the economy right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Jobs Week in America. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro, together this morning with Katie Lyons. Your equity market just slightly negative on the S&P 500. Tom, job openings a little bit later. ADP tomorrow, jobless claims Thursday, then on to Friday when you get that payrolls report.
In a Labor Day with a 3.5% unemployment rate. John, if you parachuted in from another decade, another era, a 3.5% unemployment rate would be unmitigated bipartisan celebration. Why are we so screwed up?
That's a question for Kelly Lyons, Tom. I'd throw in GDP in a mix as well, potentially with a 3 handle this quarter. Fed funds at 5.5%. And you might ask this question, if you came down from Mars, are we sufficiently restrictive, Tom?
No.
Based on all of that?
No. I sent an email to somebody today, Kitchux, I can't remember who it was, to be honest. John, we are not sufficiently restrictive. The Bloomberg Financial Conditions Index, good morning, Michael Rosenberg, 0.37 positive. At the minimum, John, you got to get that down through zero to a negative statistic. We're nowhere near the market mathematics that screams restrictive.
Earnings from Best Buy. Let's get to those numbers right
please.
Now. They now see full-year adjusted EPS. Here's the range, $6 to $6.40. They had previously seen $5.70 to $6.50. Revenue at $9.58 billion US dollars. The estimate $9.53. This for the second quarter. Katie, 122 on EPS. The estimate 1.07.
Yeah, and just looking at some of the language in the statement, they talk about how, yes, the consumer electronics industry remains challenged due to the pull forward in demand we've seen in the previous couple of years and various macroeconomic factors that they say, quote, we are all too familiar with. They go on to say that they expect this year is going to be the low point in tech demand and that next year the consumer electronics industry should stabilize and possibly see growth because of upgrade cycles and normalization of tech innovation. I guess it's not just Tom Keene that's trying to upgrade the TV situation in his home, but the idea is the picture is looking better going forward.
So are things okay for retailers right now or absolutely terrible? And Tom, I guess the answer to that depends on who you ask.
It depends on what market segment is well. I looked at, actually, I'm in the process of buying a new TV. And, I mean, the price of this stuff is prohibitive. I mean, the stupid soundbar thingy that goes under the TV.
The Sonos one?
Costs more. It's not Sonos. I can't afford that.
What did you get?
I don't know. I think Sony, but it's a soundbar thingy which costs more than the TV used to cost. That's how they built this up, where Best Buy notices gross margins here do better. That they mention it's all due to Tom Keene. Gross margin 23.2%. And the estimate of figure below.
Sounds like you went to Best Buy for the first time in a decade.
I went to Best Buy.
He's like sound bars. You've discovered sound bars.
They said a charter member of the Geek Squad's here. That's what they said.
Okay. Let's turn to the equity market. Futures just about negative on the S&P 500, but I think we can basically call it unchanged following back-to-back gains on the S&P in yesterday's session. In the bond market, yields just a little bit higher, not even by a basis point. On a 10-year right here, Katie, 4.2079.
Yeah, and we'll look to see how the bond market moves off of today's economic data because we have a boatload of it coming at 10 a.m. Eastern time, just about 3 hours from now. The first being job openings, JOLTS data, expected to come in at 9.5 million jobs open in the U.S. It would keep that ratio at about 1.6 in terms of workers and available jobs. We're looking here for any clue that the supply and demand in the labor market is coming into better balance. That is what the Federal Reserve would like to see. Then at 10 a.m. Eastern time, Conference Board consumer confidence expected to be a still high 116, down just slightly from the reading of 117 last time. How confident is this consumer still feeling, as you are seeing that resilience in the labor market, but still inflationary pressures very present? And finally, last thing coming at 10 a.m. Eastern Time, the FDIC holding an open board meeting when they're going to be talking about a proposal to require banks with $100 billion in assets to issue enough long-term debt to cover capital losses. This, of course, is something that the largest banks already have to do, but now making it apply to some of these regionals as well, given the fragility we have seen in banks of that size and, of course, the failures we have seen as well. You're seeing a continued regulatory response.
Kaylee, I thought your JOLTS chart was great. Bring that back if you would. On radio, the JOLTS chart simply signifies how many miles we are from pre-pandemic. John, JOLTS is, I mean, the extrapolation of the vector here on JOLTS to get to where we were in the pandemic screams 2024, 2025.
This Fed wants to make progress, Tom. It's making progress. Has it made sufficient progress? That's a rather different question altogether. Has the policymaker in China made progress? Let's go through this. These are considerations in China right now, according to people familiar with the matter, that the biggest state-owned banks are considering lowering deposit rates for at least the third time in a year. Another consideration potentially is to cut mortgage rates on existing mortgages. And the finance minister in China, along with other officials as well, vowing to strengthen policy support and speed up government spending. Is it enough? Michael O'Rourke joins us now, Chief Market Strategist over at Jones Trading. Michael, that's the first question to you, sir, and thanks for being with us. Is it enough?
I mean, every day China has a new stimulus program they're announcing. I think what we're witnessing is a structural shift in China's relationship with the global economy, especially the United States, that the leadership of Xi Jinping is totally different than his predecessors. And I think that global investors are starting to get really worried. So I actually think that you can announce all these measures. I don't think there's a lot of confidence from global investors believe that there's going to be any type of follow through.
Michael, is there an observable bet by traders into Labor Day, into September? Is there money being placed in preponderance on a certain thought?
Tom, I don't think that's the case. I think, especially after Jackson Hole, everybody still has their hands up in the air and everyone's still data dependent and everyone's still basically concerned. We really don't know where we're going. Like the uncertainty level is extremely high considering we should be at the end of a tightening cycle. But you guys, have the conversation as to whether or not we're restrictive. And I don't believe we are either, but Jay Powell does think we are. So you basically have a policy probably mismatch with where most of the market is, and that's a little bit of a concern.
Bramo's not here, so I got to wade in with the Bramo gloom to keep the show going. Mike O'Rourke, very simple here. Is there a gloom bet right now that I can play against?
I don't think there's a gloom bet per se, but I think we're seeing more people behave cautiously. Like, as we know, the Magnificent Seven drove so much of the gains this year. They've started to undergo a correction this month. I think Apple is a great example of what happened here. You had a stock that was up 50% year to date going to earnings at the end of July. Obviously, earnings and revenues are supposed to be down year over year. And the market said that's a little too much. The stock's about down 10% since then. I think that's what we're seeing going on right now. And there's no real reason for that to stop in the near term because, again, we don't know which way we're going with the Fed here.
Well, to your point, this was something Mike Wilson was talking about last week, the idea that NVIDIA earnings, which were kind of spectacular, couldn't actually serve as a catalyst for further rally in the equity market, he thought was pretty telling. In the absence of catalysts like that, which ones are there? Is everything going to be driven by economic data now?
Well, that's exactly the problem. You don't have this leadership of this group that is just driven performance, mostly on multiple expansion. So now we're looking at the economic data. Obviously, we have JOLTS today. We'll have the jobs data on Friday, and then we'll have we also have PCE Thursday, but that's kind of a late number because we already saw the July CPI number. But when we get the August CPI, that's going to be key. And the problem is the Fed could pause here, but we're still not sure they're done. And again, if you look at where this GDP is tracking for Q3, it says we're not restrictive. If the other members of the FOMC start to actually acknowledge that, we've seen comments from the Richmond Fed President Barkin saying that it doesn't look like we're restricted. If more Fed officials acknowledge that, then we don't know where we are in the cycle. Is it 1, 2, 3 more hikes? obviously right now feels like the Fed should be done, but they definitely need to keep the markets in check.
Well, to your point about not knowing exactly where we are, that was what Chairman Powell tried to say. He said it about the neutral rate as well. He doesn't actually know what R star is. If, though, it is higher, if the neutral rate is higher going forward, what is the implication for what returns realistically can look like?
Well, see that, and that's where the Fed should make an adjustment, because first of all, you can't say you don't know where the R star is and then put a longer term projection of the Fed funds rate in the SEP. You can't cop out like that, right? It's 2.5% in the SEP, which is a 2% inflation rate, and then 50 basis points of a real neutral, a real Fed funds rate, a real policy rate. So if you're publishing that number, there should be a number. How can we sit there and say we've had the worst inflation of 4 decades, we're 2 years into this, and that number hasn't shifted up post-pandemic? And again, we don't have that globalization that, where China, for the past 2 decades, where China exported disinflation to the global economy. That number is higher. If the Fed adjusts that, the market will then start adjusting the longer-term Fed funds rate higher, and we won't expect the Fed to start cutting every 6 months.
Venerable O'Rourke, all I know is we got ETFs and index funds. Are we playing stocks like we used to, or have we all been packaged into ETFs and boring index funds?
Tom, you nailed it. The structure, I've been in this business almost 30 years. The structure of the market's changed because obviously we've had this massive wave of a structural shift to index and passives over the, basically since the global financial crisis. And part of that's been accelerated by obviously very accommodative monetary policy, negative policy rates for the past almost 15 years. So those indexes play a big game. And that's when you see names like the Magnificent Seven, they're just flow benefit. And obviously they're great companies, so I'm not minimizing that, but they're also flow beneficiaries. And that's why like one of the biggest trades for active managers these days is who's getting added to what index. So it definitely drives trading today. It's something that it's definitely hurt the active management business, and you don't want to be subject to just passive flows that really aren't, discerning prices and values for assets. You want to have active managers in there trying to set asset prices, trying to allocate capital, rather than just chasing index flows.
Mike, thank you, sir. Mike O'Rourke there of Jones Trading. TK, we heard those arguments at the start of the year. And then the index delivered what? Double-digit gains so far year to date? I know the game's not over for 2023, but look at the move we have seen.
Yeah, but nobody cares my opinion on the market. But what I can say is there's an exhaustion by a huge body of the market that missed the October rally.
Big time.
It's just interesting to see how that plays out. Where's the next leg?
We've been saying we might revisit the low for almost 12 months now.
Yeah.
Going into September later this week, and October just around the corner. If you're just tuning in, welcome to the programme. Your equity market totally unchanged on the S&P 500. Outside of that, into the bond market, your 10-year for 2020 on a 10-year yield, and coming up a little bit later, 48 minutes away, a man who's called this market pretty well so far this year, Tom. Andrew Slimmon of Morgan Stanley Investment Management. He did not like sitting at the front end and taking that 5% yield. He wanted to play it in equities, and he has done.
I can't emphasize enough the split between those that are asset allocating out into equities, a belief to cash, a belief to bonds, whatever the song and dance is, versus those that say you can't win financially as a family or an institution unless you're in the market every day. You've got to participate.
Well, long term, yes. And this is what you were asking everyone yesterday. 3 years. What is your return going to look like if you're game planning out?
Well, it's sacrilege.
That far?
I got 3 people in here. Don't say that. It's not financial TV. We're supposed to look out 3 hours. But
always makes me laugh. Honestly, it's comedy to me when I see a financial advisor on financial media talking up single names.
Yeah.
That for me, if your financial advisor is on TV talking up single names and being in and out of the market day to day, you should have questions, Tom.
Yeah, the in and out is a huge question, but the single names is the province of the sell side, and we don't have them on enough. They do a great job, win or lose.
The sell side?
Yeah, they lose sometimes.
Sure, I mean, yeah.
Look at me.
AMH has come to work. That's a good thing. She'll be down in Washington, D.C. She joins us next from New York City.
Federal employee.
This is Bloomberg.
I know that who was watching that debate last week and who watches our country closely, and that's China. We're in a Cold War with China. We're in a proxy war with Russia. And if you've got divisiveness is it's just a huge business. And you take every cable network going 7x24, talking about indictments, talking about 2020 elections, then we're not talking about the things that we're actually facing as a nation.
That's because he's not listening to the right network. That was the North Dakota governor, Republican presidential candidate Doug Burgum, catching up with our colleague, Kayleigh Lyons. Kayleigh, what is it about a candidate with single-digit support staying in a race? Did he answer that question?
No, not really. Well, I did ask him if he can't qualify for the second debate, which is just about 3.5 weeks from now. You have to have 3% in a number of polls in order to get there. I said, if you don't qualify, he's at about 1% right now, is it time to drop out of the race? He said no. So this field stays very wide, and the wider it is, the prevailing thinking goes, the better it is for the frontrunner, the former president,
What
Donald
is
Trump.
that game about, Tom, where they just stay in the race and hang about?
I don't get it, but some of it has to do with rich guys. And this guy, and I don't think this has come out enough in the press, there was a moment where he and Great Plains Software were a huge national deal. You could
Bought by Microsoft.
You could do tech in the Midwest and get away with it. And that was a new concept at the time. And again, I don't think there's enough made about entrepreneurship. This is a guy who is a success, and he's almost subsuming this in the Wall Street, Main Street tension of the nation.
We'll return to that a little bit later. I just want to run through the price action for you. Totally unchanged on the S&P 500, going nowhere. In the bond market, yields higher by not even a basis point at 420.79. So a really, really snoozy market this Tuesday morning. Citi just publishing. We caught up with Veronica Clark in the last hour. This from Andrew Hollenhorst, Veronica, and the rest of the team. JOLTS job openings likely to stay elevated. So this is job openings data coming out a little bit later. They say strong demand for workers, historically low unemployment should keep wage growth strong going into Friday. Meanwhile, Tom, to the data point that you're looking for, Case-Shiller house prices likely advanced at close to 10% annualized in June as higher mortgage rates have limited the supply of existing homes.
Yeah, and
Isn't that the truth?
It falls into price. To be clear, Case-Shiller, and everyone knows I'm a huge fan of what Carl Case and Bob Shiller did. And the bottom line is, it's like trade balance. It's dated. It's 1-2 months behind. So we're not getting a snapshot of housing, but coming off the mat, 0 or even -%, it would be shocking to see that puppy pop above 0.
Amazing to see, isn't it?
Yeah. Are we ready?
We are, yeah. I'm waiting
Let's
for you.
go. It's Super Tuesday today. And we're going to go to Anne-Marie Horton, our Bloomberg Washington correspondent here. I have no idea how this works, Anne-Marie Horton. There's going to be Super Monday in March where the former president of the United States is going to somehow be on some kind of trial, and 24 hours later, Donald Trump is going to go on to Super Tuesday. How in God's name is that 48 hours going to happen?
Well, it looks like the former president, who is a candidate for the 2024 presidential election, is going to be potentially sitting in court when it comes to Super Tuesday. And Super Tuesday is important because it's the day that all of these states, more than 12 of them, go out, they vote. Delegate-rich states like Texas are included in that. And this is going to be happening while a candidate and a former president is going to be on trial. We should note, this is the trial in Washington, D.C. This is the January 6th election interference trial. And Judge Chutkan basically said she is going to have it in March. Now, what you heard from Jack Smith is they wanted it in January. The Trump team wanted it well beyond the election. They wanted it in April of 2026. But she said, no, it's going to start in March. And we spoke to a former White House counsel under the Trump administration yesterday, Ty Cobb, and he thinks that this date stands. He says potentially it can move by a week or two, but he says this timing is looking accurate.
I mean, look at Super Tuesday, Biden, Alabama, Arkansas, Maine, Massachusetts. Michael Bloomberg won American Samoa. How about that? Let's go on to the Republicans, where Donald Trump crushed Governor Weld of Massachusetts. Who's he going to be up against this time, or is this already decided when we get out to March for the Republicans?
It's not already decided. Look, we are a long way away from November of 2024. A lot can happen. Yes, the former president has a wide margin when it comes to the polls. I'll quickly pull up 538. And right now what you're seeing is Trump, as of August 28th, 49.2%. Just under him, DeSantis, 14%. 0.9%. What you did see from the former president, though, is a little bit of a dent in his polling numbers following the debate. And then what you see is also, when you look deeper into some of the questions that are being asked amongst these individuals, is would you maybe consider voting for someone else? For a lot of people, they are just getting introduced on a national stage. So while it was only that one first debate, there is potential that someone can break through. Obviously, the issue is just 24 hours after the debate, the former president obviously made headlines when he was the first former president to have a mugshot. And that was, of course, in Georgia for another interference case when it comes to the 2020 election. So it's going to be difficult for someone to break in, but we should note that there was a little bit of movement following that debate.
Okay, well, of course, the one who was thought initially when this race first started, Anne-Marie, to pose the most significant challenge to the frontrunner Donald Trump is Ron DeSantis, who is off the campaign trail this week because of potential crisis in Florida as a hurricane is bailing toward the Tampa area. Could be a Category 3 when it makes landfall tomorrow. It's a reminder that this is also an active governor, not just a presidential candidate. How does he balance the two when his campaign also is flailing?
Well, not only that.
Enunciation is important.
Not only Yeah. Well, not only that. I mean, Governor DeSantis has really been trying to break through. They've been trying to have this reset, this restart, because a lot of the big donors are still waiting on the sidelines. They didn't really feel comfortable with what they were seeing at first. Maybe he was playing too much into this anti-woke corporation slogan and going after big companies and their largest employers like Disney. That didn't sit well with a lot of people. Also, his initial remarks on Putin's invasion of Ukraine, calling it a territorial dispute. So this actually could present him a moment, right? There are sometimes also moments in a crisis that could present themselves for him to act presidential. I mean, he got on the phone, had to get on the phone with current President Biden. These are moments where he can act presidential to come to the help of his state. We should also note, though, while he's going to be talking a lot every day, you're going to see him on TV talking about this hurricane that's going to make landfall in Florida, I believe, tomorrow. He was also booed as well when he was talking about this racially charged shooting that happened in Florida. So there's going to be potential moments for him to shine, but also moments for the Democratic Party to also go after him.
Yeah, and of course, we heard a lot from the Democratic Party and its leader, President Biden, about that shooting in Jacksonville. Just quickly on the subject of Biden and not what he's doing domestically, but the efforts of the administration abroad. Gina Raimondo in China as we speak. She's there for another couple of days. Are we seeing real signs of tangible progress on this visit compared to the others we have seen administration officials take?
Well, the G0 newsletter from Ian Bremmer today says good vibes between the U.S. and China relationship. It does seem like in this meeting, compared to all the others that came before her, she is making slight progress when it comes to communication. They're setting up a working group to talk about trade and investment. They're going to have better dialogue when it comes to export controls. And this is the quote that really stood by me. Apparently, she told the Chinese premier, who was the number 2 official, according to Associated Press video feed, quote, President Biden asked me to come here to convey the message that we do not seek to decouple. Remember, this administration has been trying to tell the Chinese government, we're not trying to decouple, we're trying to de-risk. And there's one line that Gina Raimondo, the Commerce Secretary, has really wanted to bring to Beijing, and that is that barring national security concerns, we have much more to discuss when it comes to trade and investment than we do when it comes to national security concerns, meaning there are a lot of trade and investment that have to do outside the purviews of these national security concerns when it comes to export controls that we can be discussing. And at this moment, China obviously is looking to revamp in terms of global investment as well. So it does look like she's getting that message across.
30 seconds on the clock. MH, just curious, why is it always US officials going to China and never officials from China going to the US?
Well, that's a great question. That's many questions Republicans have been asking. But there's going to be an APEC summit in the United States in November. And I would say stay tuned till the end of the year.
Stay tuned. Thank you. Anne-Marie, MH on the latest down in Washington, D.C. Tom, de-risk, diversify.
Decouple.
Not decouple.
Not decouple.
Not decouple. No way. It's not about
De-risk.
that. It's about diversifying.
And
I would look at China and say it's not Shanghai, Hong Kong, and Beijing. There's a whole bunch of other cities flat on their back.
Sure. Juice Beaumont
Domestic.
of ABN AMRO coming up very shortly. Your equity market totally unchanged on the S&P 500 from New York. Good morning. 2 hours away from the opening bow, following back-to-back gains. Your S&P 500 stalling just a little bit here, unchanged on the S&P. On the Nasdaq, negative by 0.1%. Almost unbelievable to think we've had the first back-to-back gains, first two-day winning streak on the Nasdaq for August so far, as we look to close out this month and look ahead to September with a Federal Reserve decision just around the corner. Your bond market's shaping up as follows: 2-year, 10-year, 30-year, 2-year, still in and around 5%, Tom. 5% going into payrolls on Friday, and I believe yesterday at the close, the 6th straight session where the 2-year yield has closed above 5%. So we're hanging in there over the last week.
My single statistic through the data Friday is the 10-year real yield, 1.91%. Vacillating is the right phrase. It's been going up, going
it's
even
a good
down.
word.
And it's fancy. But to see it break through higher and revisit 2% would be headline making.
You're so fancy with that bow tie
well,
today.
Know, well, for Kaylee, we're all cavalier.
Very cool. In the FX market, the euro looks like this, clinging to 108. The data out of the Eurozone just has not been great at all. 108.08. That currency pair, Tom, negative 0.1%. You caught up with ECB President Christine Lagarde going into the ECB, and that ECB seemingly does not want to give anything away going into that decision on September 14th.
Not only that, but I think they're respectful of what the market reaction could be in bonds. I mean, bonds there aren't like bonds here, but within the entire towards banking instruments, toward debt instruments, towards banking instruments, and the floating nature of so much of this, they're walking on eggshells to get to September 14th.
Under surveillance right now this morning, US Commerce Secretary Gina Raimondo continuing her trip in China, telling the Premier, quote, President Biden asked me to come here to convey the message that we do not seek to decouple. It is still unclear whether Secretary Raimondo will meet with President Xi Jinping before her trip concludes later this week. We don't want to decouple. This has been the message continuously through the year. Yep. Kaylee, Secretary Yellen tried to convey the same thing. The word Secretary Yellen used was diversify.
Yes, after she had moved on to de-risk. They're really trying to finagle the language here to not potentially indicate to China that they really are trying to cut ties with that economy and with that trade relationship. They say that's not what they're trying to achieve. It's about protecting national security interests. But to your point, John, of the question of whether Raimondo will meet with Xi Jinping, we're also wondering if President Biden will be meeting with him again. They haven't spoken since last November.
Is that set for later this year?
Potentially.
Potentially, maybe. Is that what we're working towards with this?
Perhaps. That would be the indication. Get those ties warmed up with other administration officials for a meeting with the two leaders. But of course, the language, to your point, John, on what he's been saying at campaign fundraisers, calling Xi Jinping a dictator, China taking time bomb.
I don't
can imagine that might not be that helpful.
If I'm in Congress, I'm listening to John Ferro. Why aren't they coming here? You asked that question.
I don't know the answer to that.
That's a really good question.
Well documented that the leader of China hasn't traveled much since the pandemic.
Well, I don't mean just the leader, but the other ministers as well. It's a one-way.
Some of them are
to me, it's a one-way
by the U.S. government,
it's a one-way
like the defense minister. That's been a problem.
Yes, a big issue. The latest out of China this morning, so much to talk about. The potential that we get deposit rates cut, the potential we get mortgage rate cuts, the potential we get fiscal easing. But I stress the word there that we need to emphasize is potential. We just haven't seen these things in big ways to support this market or this economy for that matter. The other story to talk about, the head of bank supervision at the San Francisco Fed, Azar Abbasi, stepping down months after the banking crisis of Signature Valley Bank. Abbasi and Fed President Mary Daly under scrutiny in the wake of the collapse of SVB and other lenders as well. Abbasi will retire at the end of October. The San Francisco Fed is yet to respond to the timing of the departure, Tom. It's going to take place a little bit later this year, about a month or so.
Yeah, I see Mary Daly at Jackson Hole, and you sort of wonder how that's all going to be played out, and this is obviously the first step of it. And there's discussion about Daly's distance from all this banking debacle. I'm not up to speed on it, other than to say this doesn't surprise me at all.
The surprise is the timing, that it's taken this long to get to this point.
Yeah.
No, I think
it's kind of odd.
People would say, let's go, but the fact is the machine moves slower, and so that's where we are.
We'll try and get more clarity on that. And the final story we need to just keep an eye on over the next couple of days, particularly, of course, for the residents of Florida. Hurricane Idalia set to make landfall on North Florida by Wednesday. High winds, storm surge could deal as much as $10 billion worth of damage. The Florida governor, Ron DeSantis, expanding mandatory evacuation orders for the counties in the storm's path, Tom. It's that time of year, and this one looks pretty brutal so far.
I believe it's north of where it was last time, but not only people on the west coast of Florida, but, John, many surveillance guests who have places down there, I think hammered is the proper where they really got a lot of damage.
Big time. One to watch, and of course Wednesday the data watch, Tom. So we'll be on top of that story tomorrow.
Yeah, we'll have to see, but we'll follow this carefully. And a movable feast always within the Gulf of Mexico. Joining us now on bonds, and particularly on the European dynamics of bonds, off the mystery of what the ECB will do, is Joost Beaumont, head of bank research at ABN AMRO, as well. What do bonds tell you in Europe? And let me go to the German debt market, which is what we follow in New York. What do German yields signal now?
Well, investors are heavily divided about what the ECB will do. I think what yields signal is we've seen a bit of a 10-year rise, a bit of a flattening of the curve. So investors are a bit worried that inflation will be around for longer, and that will result in higher rates for longer as well.
You and ABN AMRO just did a fancy survey of the mood of those that need yield. Are people clipping coupons, or are they actually looking for some form of total return?
Investors are looking for total return, but indeed, we did an investor survey. We do it twice a year, and we had more than 170 investors responding. So quite a big survey across a wide range of countries. We will publish a note, but a sneak preview showed that indeed about 10-year bond yields, some investors think it will end up 3.30, others think it will be at 2 something percent. So it's I think a bit to what you said before. The conditions at the moment are so uncertain. It's so unclear what path the economy will go and what central banks will do, and that is also heavily reflected in the results of our survey, to be honest.
But given what you're saying about how uncertain it is, and that is also the message that Jerome Powell, I think, was trying to convey in his speech at Jackson Hole, that the cloudy stars night situation poetry, basically that they just don't know. And yet what you're seeing in the Treasury market in particular seems more definitive. John was just talking about north of 5% on the 2-year yield for multiple sessions in a row. That auction yesterday, the 2-year auction yielding the highest since 2006. Is the bond market more sure than the policymakers actually are?
Maybe, yes. In our view, the central bankers, and then I especially talk about the ECB, is way too optimistic still in its latest projections about the economic growth. They expect actually a pickup in growth in the second half of this year, which seems a bit at odds with the more than 400 basis points in rate hikes and the fact that still needs to filter through to the real economy. So we expect much slower growth. Actually, we expect a mild recession, and you can maybe call it stagnation. At the same time, the ECB also expects inflation to remain high for longer, while actually the key here is the labor market. And we do see now early signs of the labor market turning, weakening. We see wage growth having reached its peak, coming down slightly, still strong, but it's coming down. So we do expect inflation to drop quite significantly during before the end of the year. So that will set the path for actually rate cuts next year.
Okay, but if you're talking about... If you're talking about some of that tightening starting to kick in a more material way, the economy is starting to feel it, are we also going to start feeling it in a more material way in credits? Are we going to see defaults actually pick up in a way that they haven't yet, as some may have expected?
Well, there are early signs. For instance, Eurostat publishes about bankruptcies, and these see a continuous rise in the past couple of quarters. So I think definitely also with a lot of companies and households having benefited from government compensation schemes, that is likely to be much less next year when governments need to step on the brakes or to curb expenses. So I think the outlook for bankruptcies is not great. Then the other question, of course, is can banks, for instance, cope with that? And in that respect, the answer should be yes, because we just had a stress test showing banks are pretty well capitalized and can cope with headwinds. But sorry, you want to ask a question?
Well, Yus Beaumont, thank you so much. We have to go with ABN AMRO this morning on fixed income in Europe. John, you're expert on this. And the thing that I noticed at Jackson Hole and what we heard from Mr. Beaumont there moments ago is an intelligent debate completely ignoring the polarization between Germany and Portugal. I mean, I just don't think anything's changed in terms of the tensions in Mike McKee's conversations at Jackson Hole.
President Lagarde was right not to talk about September 14th. Because what we need to be talking about in Europe is not German business confidence, not the latest PMIs, not where core CPI is. All of those things are important, but far more important than that. The European model has failed. And it has failed with Germany at the heart of that failure. Not Italy, not Greece, not Spain, not Portugal, Germany. And Tom, on three fronts: trade, energy, security. And we've talked about this endlessly, and we should keep talking about it.
Yeah.
On trade, they've outsourced their economic security to China. And they find themselves between a rock and a hard place, the United States and China, on what to do going forward from here. On energy, totally exposed to the story in Russia and totally exposed to a strike even over in Australia. That's how fragile things are right now. So, Tom, that's trade, that's energy. On security, for a long, long time, outsourcing their national security to the United States of America and seemingly keeping those three things, Tom, those three things in balance for decades. And that's fallen apart in the last 18 months.
To me, and I'm speaking as an amateur, they've lost the manufacturing marginal edge that was always there to save them. I believe in London, folks, we'll have an extended conversation with David Folkerts-Landau. It's going to be really interesting to see what Dr. Folkerts-Landau says about all this.
Agreed. After a decade, Tom, of looking down our noses at what's taking place in Italy, in Greece, in Spain, in Portugal, and Ireland, it's at the heart of Europe, led by Chancellor Merkel, where really poor decisions were made, Tom. And I've yet to see what the plan is from here.
Well, that's why we have the Lagarde speech. There isn't a plan.
From here.
There isn't a plan.
Doesn't seem to be one at all.
Adam Posen, off the record, I don't want to quote him directly, but he was heated with his expertise in the German experiment in America. But Dr. Posen made very clear they're avoiding the plan because there isn't one, plain and simple.
If you are just tuning in, welcome to the program. Your S&P 500, slightly negative. We're down here by 0.08%. In the bond market, yields a little bit higher by a single basis point on a 10-year 421.38. Coming up a little bit later, 8:30 Eastern Time, so about 48 minutes from now. Jay Bryson of Wells Fargo on the U.S. economic outlook, pushing ahead, Tom, to jobs numbers on Friday, claims on Thursday, ADP tomorrow, and job openings a little bit later this morning.
And something that we really haven't talked about is on a blended basis, DXY, the traditional dollar big country index, is a 104, and that's maybe the surprise of the late summer. Remember all the weak dollar talk?
Oh, yeah. China was going to deliver. Europe would outperform. You wanted your money elsewhere.
International stocks and all that.
And then a few months in, it was US exceptionalism.
We're right back to buy more Apple.
With some bank failures in between. Kelly, it's been quite a year.
It has. It has indeed. And on the subject of those bank failures, that's what we're looking out for. Just a couple hours from now, the FDIC likely to add debt requirements to some of those regionals as we think about what is going to stabilize them going forward to avoid the failures potentially of the future.
What's this headline all about here, Kaylee? I'm sure you've read it. You understand this story better than I do. So pharmaceutical giants spanning Bristol Myers Squibb, Pfizer, Eli Lilly, the first targets of President Biden's historic foray into bargaining with drug makers to lower the cost of medicine. What's that about?
Yeah, this is a big part of the Inflation Reduction Act, essentially, that the government is going to negotiate with these companies to set prices of some of the drugs that contribute most to those costs. About 20% of Medicare Part D prescription drug costs in the year are these 10 drugs that they have listed. Now, some of them likely were anticipated already. There had been some previews indicating that some of these drugs would be included on the list. And so preemptively, you've already seen lawsuits filed against the government. This could get very litigious.
Prices may be cut 50%.
Yeah.
Saving Medicare $100 billion by 2031.
Is Trump on the same page as Biden on this? I think they are. They want lower drug prices.
Potentially.
Yeah.
From New York City this morning, good morning. This is Bloomberg.
You actually see bifurcation in the housing market. Existing home sales are down in the dumps and prices are falling year on year because mortgage rates are so high. Why would you move if you're going to have a higher mortgage rate than what you have now after you've probably refinanced a couple of times during the pandemic. But then with new housing, we're starting to see a little bit of a pickup because you can't get an existing home.
The housing market in America is an absolute mess. That was Dana Peterson, the chief economist of the Conference Board. It's an absolute mess because in the space of 2 years, we've had record low interest rates and the highest rate in 2 decades. So, Tom, people with a 2% mortgage don't want to move, and people facing an 8% mortgage, 7%, whatever it is right now, can't afford to buy. That's where we're at right now.
Well, it's the first in the world housing market. And again, John, the fundamental thing to me is how it folds over to rents. And I don't think I know. I mean, I think there's a real mystery of how this ends up.
So let's say you're in a city, you're locked out of home ownership. Tom, they can't build fast enough. You're going to have to rent, aren't you? So what do you think is going to happen to rents? And that's the problem, particularly in places like New York City.
New York's out of control. I mean, we can all
Totally.
state on a social basis, New York is an absolute disaster, but does that speak to the rest of the country? I'm not so sure.
DC's bad too.
DC's bad too. Thanks for that. You know who's loving it? The home builders.
Yeah, they are.
Home builders, the
100%.
stocks, yeah. Since last year, they get the joke.
We're going to get a brief
Big
on the
time.
joke right now with Kay Schiller coming out. Stay with us through the morning on radio and television for that important data. Joining us now, smartest guy in the block, John Lovallo, U.S. home builders analyst at UBS. Did you see this coming? Like, were you like pounding the table, UBS strong buy, back when everybody said they're all going to die and they didn't?
I'll tell you, we came out of the gates pretty bullish when we launched about a year and a half ago, and we did not expect this to play out the way it did. However,
But your thumb up. You were a thumb up at the time.
100%. And I mean, we were looking at stocks that were trading at a fraction of book value
Right.
when we saw very little risk to book value.
Now what? I mean, a D.H. Horton, venerable company, are they all, the executives all unloading shares and that on a log basis? It's log convex to say the least. I'm going to call it a moonshot. Now what for the home builders?
We're still bullish. I think that it's an incredibly interesting dynamic that's playing out right now where there is just very, very little existing home inventory, 3.2 months to be exact. That's about half of what it should be. And so you couple that with the fact that demand out there is still resilient, regardless of the fact that rates are at 7.5%. And the demand is all being funneled towards these public home builders.
I just wonder how long that could last, John. If we're north of 7 already, on the approach to 8%, that's got to hit demand at some point, even for people who are trying to buy new.
100%. But the beauty of being a public home builder is that you have arrows in your quiver. What they can do that the existing
Incentives.
Incentives. So they can buy down mortgage rates. And not only that, they can build smaller footprints. They can build a little further away from the city center. So there's optionality that the existing home market doesn't have. You can't pick up the home and move it. And so there's a lot of things that are favoring being a builder at this point.
So, John, in the UK, this can slowly correct because the fixed rate mortgage over there is maybe an agreement for 2, 3, 4, 5 years, some even on floating rate. The US mortgage market, 30-year fixed. I'm trying to work out, John, are we facing something generational here? Is this something that goes over the next decade, 20 years? How are you thinking about that? Just what kind of time horizon have you got for this to play out?
I think that there's a long, long runway here in the U.S. housing market. You have, first of all, massive generational wealth transfer, $68 trillion being funneled from baby boomers to millennials and Gen X. And you have an underbuilt housing market in the U.S., and a lot of millennials that are coming to the market right now that have been kind of shut out of the market for 15 years. And all of a sudden they're saying, well, you know what? I think we do want to own a home. They're a little bit wealthier than prior generations. They have the ability to borrow from parents and so forth. And so that capacity and ability to buy is actually there. And you add to the fact that
So our housing market is based on rich parents giving money to kids.
That's part of it, for sure. But I would say that the generation that's coming through right now as a first-time home buyer is a little bit better heeled than prior generations because they're a little bit older. They're doing things a little bit later in life. And so there is wealth that has been accumulated. And this is a need-based buyer, right?
Okay, the fancy people you follow have, I mean, granite's out now, right? In kitchens, you don't do granite
It's
anymore.
quartz now.
Quartz, thank you.
Yeah.
Kaylee Line's on top of that. Everybody you talk to's got quartz kitchens. Why can't we build a starter home that's respectful? Why can't we do that?
It's a great question, Tom. I mean, the one thing that this industry has not done over the years is really sort of adopted technology like other industries have. Think about the automotive industry, right? they're building a home today exactly the same way it was built 100 years ago. So there needs to be technology infusion into this industry. There are a lot of players that are working on this.
I mean, John, we had an ice rink in the backyard, and the ice skates to the refrigerator cut through the linoleum floor, and nobody cared. And now, it's a quartz counter, right?
There's
What's
an
a quartz
aesthetic to
counter
maintain.
cost? Yeah.
Well, but on the subject of cost and of the tools that are actually being used to build this home or these homes, part of the issue with rates being so high is because there's a fight to get inflation down. And a lot of that inflation was actually just driven by supply chain challenges. Are builders still contending with that? Are there any supply issues that still are being worked out?
The supply chain has gotten much, much better. I mean, there are still some hangups on electrifying communities, so transformers, things of that nature. But in general, the supply chain is getting a lot better than it was. And I would say, the biggest sort of headwind, if you will, would be labor. I mean, we're just, in a labor-constrained market. But the public builders, given their size and scale, have the ability to attract and retain better than the smaller builders.
Okay, so as we're talking about the different public builders and of the different, to Tom's point, a starter home versus elsewhere in the new build landscape, between like a luxury player, a more luxury-oriented player, or one that is more for that base consumer, who fares better in this environment? Is it the luxury end?
It's a really good question. We still actually favor the entry-level first-time buyer, and that would be a D.R. Horton, and that's because this is a very need-based, life-driven buyer, so marriage, children, things of that nature, that require more space. And so to the extent that that person can make the math work, they're going to make it work. And you know what? The public home builders are going to help them make that math work. Now, to your question, though, we like the other side, too, so sort of a barbell approach, where a Toll Brothers of the world, for instance, who just reported a massive quarter, that buyer is a little bit more shielded from interest rates. We have 25 to 30% that are buying with cash, for instance.
How disciplined are these home builders being? That's what we're really trying to get at here.
Yes.
When you are able to construct really bullish theses for things like home builders, where we can sit here and say this might be a 10, 20-year runway for these guys. If I'm listening to that, I'm just like, let's build, let's go, let's go, let's go. How disciplined are they being right now?
It's a great question, and it's really what has changed between today and maybe pre-financial crisis, that there's been a lot of discipline instilled in the market because of the pain from the past. But maybe just as importantly, there are some capacity constraints, particularly on the labor front, that will not allow them to overbuild. So even to the extent that the industry wanted to overbuild, they wouldn't be able to. So there's natural governors to the growth, which I think are very healthy.
I can't wait for these high prices for the rest of our lives, Tom. Seemingly that's the story right now. That could change. When you say things like that in the housing market, you just wonder how quickly things can change. John, thank you. John Lovelow there of UBS. Just some headlines crossing the Bloomberg on Gina Raimondo, Katie, the US Commerce Secretary, who's headed to China this week through the next couple of days into Thursday. Here's one of them for you, Kaylee. We'll wait and see if there's any action from China. We were able to open US-China lines of communication. Translate that for us.
Well, so maybe that is something tangible, but really that is what all of these visits have been about, not just for the Commerce Secretary, but Treasury Secretary Janet Yellen as well, the climate envoy John Kerry. It is about the lines of communication, reopening a dialogue in what has been a very strained relationship between the U.S. and China. So it's not as much about actual tangible outcome as more just continuing talking, continuing the conversation, and in theory laying the groundwork for a conversation to happen between Xi Jinping and President Biden.
So they come over here. Are we going to have lines of communication?
If they come over here.
Yeah. I mean, I think your point is really well taken.
I get that it's politics, and I understand why the language of politics is important, but I find it frustrating when it comes down to using the words like diversify instead of decoupling. Tom, what matters to me is action. What are we actually seeing them do? They're incentivizing companies to produce at home. Some of these companies now feel incentivized to move production away from China. And one dynamic we've discussed increasingly is now being in China for China. So if you have a manufacturing base there, it's not to produce product for the rest of the world. It's to produce product for Chinese consumption. And these are big changes, Tom, that we've seen accelerate arguably in some places over the last couple of years.
What I'm going to do is go inside the Pacific Rim. I think we're focused on 3 cities, and so are our fearless leaders. And the answer is there's a whole other China out there that Beijing has to address. And I'm just looking at the domestic dialogue as front and center.
They're trying to support.
Versus the Shanghai dynamics. Where's Yuan? Has it moved off any of this? No, 7. 7.29.
Trying to support that economy, trying to support that property market, and finding it increasingly difficult to put a floor under this equity market too. Andrew Sliman of Morgan Stanley, he's been bullish, constructive, optimistic on this equity market all year. And for much of this year, he's been right to be bullish, constructive and optimistic. That conversation up next from New York. Good morning.
Federal Reserve, in our view, probably has one more quarter-point hike up their sleeves.
I don't think that the Fed will be raising rates in September, but we do see the possibility in November.
Of course, the Fed will have to upgrade its growth forecast, its inflation forecast, and downgrade unemployment forecast.
Our expectations are that we do continue to see inflation pressures wane in the U.S. economy.
I think we're already there in terms of seeing how high rates can go.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A busy August week, jobs week, and all that. John, it's a real estate show. Just did that with UBS here. We've got to cut to the chase. Arlington, Virginia, starter home. Thank you, Toll Brothers. $1.9 million is the starting price.
It is the problem at the moment in this country.
It's just amazing.
If you've got a 2% mortgage, maybe 3%, you're not going to want to sell. And if you're facing a 7% mortgage to buy, you're certainly not going to be able to buy for many people in this country, Tom. So this housing market at the moment is just frozen up. And you see it from data point to data point to data point. And you wonder what the consequences are going to be over the next, not 12 months, over the next decade if we can't address this.
In the parlor game we're living, forget about the generational stuff that I've given up. Kaylee and her generation's trying to figure out what to do here. To me, John, the real issue here is how it folds into the surveillance world, which is owner's equivalent rent and other inflation metrics.
Yep.
Can inflation come down if real estate's pushing against it?
Andrew Hollenhorst of Citi has been asking that question, Tom, as well. And I think it is such an important question. He's also asking a question about strikes, by the way. So the latest from Andrew. He said this: recent strike activity, an important reminder of labour supply issues that would mean downside risk to monthly job figures, but further upside pressure on wages over the medium term. So, Tom, thinking about the potential for strikes and that labour disruption to maybe show up in the jobs figures in different ways going into payrolls on Friday.
Our team in Detroit, legendary, and they're making pretty clear, Kaylee Lines, these strikes at UAW are, I don't think they use the word more than likely, but the idea that it needs to be considered into the end of the summer.
Yeah, and not just a strike on one, a strike potentially on all big three simultaneously, 150,000 workers who have voted to authorize a strike should a deal not be reached by that deadline of September 14th. And what they're asking for, they have self-described, is audacious. 46% hike in wages, 32-hour work week, some measures related to pensions as well. But it's a big ask. And so how do you meet in the middle and avoid a potential strike that could have serious consequences for the manufacturing economy?
That was my massive angst yesterday. How do you do a 32-week? And David in Detroit, our bureau chief, David Welch, said, John, it's very European. This is what they're doing in Germany. And he said that.
You're taking shots at Germany.
The UAW's taken this from, I guess, BMW and the rest.
Some of those union rules in Europe are amazing, Tom.
Yeah.
At certain times, the phone just shuts off and you can't receive emails anymore. You go away and no one can contact you. It's a beautiful thing.
$3 million. The front porch of the home provides pristine views.
This is in Arlington.
Pristine views of the community and a sense of tranquility. The guy
Nothing is tranquil about paying $3 million for a house with a 7% mortgage rate.
The tranquility.
This is going to be, Tom, I think, the epicenter of the economic debate going into next year.
And the election.
Every election cycle, the American dream. How accessible is that dream? How on earth can you buy a home in this country, Tom, if you don't already own one?
With a great team of drivers we had with the taxi service and UBS, thank you, Meredith, for getting our cars wonderful in Jackson Hole. There was no other talk in Jackson Hole except $4,000 a month rent.
Frozen
that was the key topic.
Totally frozen out.
Yeah.
Big
Let
time.
it go. Yeah.
Am I going to let it go?
We're going to do a data check now and save the show. I'm going to go to the 10-year real yield, folks, as my number one statistic, 1.91%. John, what do you see?
Isn't that a song, Let It Go?
It is.
Frozen.
Yeah, Frozen.
By
Is that what you were
Elsa.
about to, Frozen. Now I get it. Honestly, it takes me a minute sometimes. All right, now I get it. Some of you just got to talk it out, Kaylee, and it starts to make sense. All right. Futures on the S&P, frozen. Let it go. All right, Kate. Futures negative, almost 0.1% on the S&P 500. Translating Tom Keene, full-time job. Yields higher by a single basis point. A 10-year Tom, 421.78.
This is a joy because he is the one who has been right, and also he's the one who's been responsible. Andrew Sliman joins us right now with Morgan Stanley, Managing Director of FEAR, Senior Portfolio Manager at Wrigley Field in Chicago. Andrew, flying over Wrigley Field, I'm sorry, going into O'Hare there and looking down at Wrigley Field, it's God's country. You are in the market. How do you find the courage to be in the market now?
Well, I think really the story of this year is, it's a tragic story in many ways, which is stocks look forward. But as Warren Buffett said, people use the rearview mirror to frame their viewpoint. And we had a terrible market last year. And that's when you're supposed to get more bullish after a down year. Right. People looked in the rearview mirror and saw a down year and got more pessimistic. So it was in hindsight, it was pretty, in my opinion, you had to put the chips in because we had a bad year last year. And what I see now is all that money that washed out of the market hasn't capitulated back in. Sentiment has gone up, but flows haven't turned positive. And I've never seen a bull market where ultimately people reverse and flow back into the market. It happened in 2021. I think money market yields being where they are keeping people on the sidelines. But I just refuse to believe that ultimately this cycle won't end the same way, which is we got to get everyone in before the boat sinks.
How do you identify a second leg of the bull market? You and I know the pop-off 74, first leg up off that mess was amazing. And then shock of shocks, I believe it was January of 75, we had a moonshot out 18 months. How do you figure out you're beginning a second leg?
Well, I think there's, in terms of from now to year end and then looking further out, I think we're in a pause period now, but I suspect we'll have a strong fourth quarter for three simple reasons. Number one is what I said is, and Jonathan's actually quoted me on this, which is the pain of being out of the market is going to become more acute as we get in the fourth quarter, knowing that you got to go see clients and report, how they've done relative to the market. That's first. Number two is earnings growth rate is going to inflect from negative year over year to positive later this year. And thirdly, and I don't think this gets enough focus, the amount of money that the government is going to unleash in the CHIPS Act, Infrastructure Act, IRA Act, all coming starting the fourth quarter is huge. And that is going to invert the M2 positive. That's another reason. So all those, I think, will drive the market higher. What I struggle with, and you guys have already touched on this, is how are we going to get back to 2% target, which is what Jerome Powell told us last week he's still targeting, with wage pressures, all this public works spending coming. I just don't see that, and that worries me about next year. Okay. But I think for this year, it's a good setup.
Okay, well, but to expand on that point, we actually were just getting headlines out from President Biden related to the Medicare drug negotiation, part of the Inflation Reduction Act, to what you were just referring, trying to lower healthcare costs. But to your point on all of this fiscal stimulus, an impulse that could kick in later on this year and going forward, does that good thing then become a bad thing when you're talking about more money being pumped into the economy and potentially what the Fed is going to have to do to counteract that force?
Sure. But absolutely, it's a long-term negative. But look what happened, COVID. We pumped a ton of money into the markets, into the economy, and the market responded positively. So I think there's a positive response to that spending money. And we hear it from the companies. And this is one of the reasons why I like the industrials. We're hearing these companies say the money is coming. We've got projects set up to do. So I think this will drive a big part of the economy and earnings. But it's going to extend this inflation fight longer than I think many expect.
Andrew, inside baseball question. Jeff Curry at Goldman Sachs retiring. They're out of the oil racket. talked about how the new yield structure, getting us back to pre-2007, makes inventory management in hydrocarbons completely different. I would suggest across America, we underestimate what inventory management, given a real yield, how it changes corporate behavior. I would suggest corporations will begin to adjust viscerally to these new yields. Do you agree?
Well, there's no question a rising yield curve creates a higher cost of capital. And eventually that's why, rates going up causes a recession. And I don't question that inverted yield curve is also suggesting that. The question is when, and it's not very good at predicting. And I think what is really going on here is that actually for most of the companies in the S&P 500, higher yields is a net positive because they've locked in fixed rates, but they're making more on their cash. So right now, it's not a negative, but certainly as that debt comes due, the cost of capital will increase. The other thing that will slow is ultimately CapEx spending because projects are harder to justify at higher yields. I think that's all to come. I just don't think it is this year or early next year.
Andrew, is it a negative for the banks?
Yeah, again, it's the cost of capital. So I think that the spread, the margins remain higher. What I worry about, will we have another SVB crisis out there? It doesn't look that way. We watched the borrowing at the window. It doesn't look that way to us. But ultimately, are there other banks that have a duration issue? That's a tough question to answer.
They've just not traded well over the last month, TK. The financials. It's been a tough one.
There are other areas in value I would search for.
Andrew, do you want to finish there? You've got about 15 seconds if you want it.
Well,
what are those other areas?
Sure. I think the industrials look very attractive because I think with this public work spending coming, I'm very comfortable that these companies are going to make or beat the numbers, whether it's materials, industrial companies, with this spending that's already been approved. So this has already been approved. I think that's a cleaner area than financials right now.
Andrew, thank you, sir. Andrew Sliman there of Morgan Stanley. If you're just tuning in, welcome to the programme. Your equity market on the S&P 500, negative 0.03%. Coming up a little bit later, 8:30 Eastern Time, so about 20 minutes from now, catch up with Jay Bryson of Wells Fargo. 18 minutes to be precise, Tom. That interview, just around the corner.
Huge response to our real estate discussion. Home economics surveillance, that's what we do and do best. There's mortgage calculators out there on the 1.9 million starter home in the Washington area, $380,000 down, and you pop it a $9,000 per month. And if you, John, you make this thing in a housing panic of bringing the down payment down to 5%, you're just over $11,000 per month, John.
My favorite chart, Michael McDonough, I have it saved on my phone, so I'll share it with you. Okay, how much home can you buy with a $2,500 monthly mortgage payment, assuming a 20% down payment and average 30-year mortgage rate? Now, you cited these numbers a little bit earlier. So the previous number, so the peak of that in the last 5 years or so, the last several decades, that was just after 2020, and you could borrow $758,000 worth of house. That's what you could buy, almost $760,000 worth. That house you can buy now, that house value is $440,000.
Yeah. And to me, it's a down payment. I mean, Kaylee, the reality here is if kids don't have parents that can write the big check or grandpa or whatever it is, I mean, I just think it's complete societal hogwash.
Well, especially when you're talking about so many people being locked out of buying, they're then forced to rent, driving rental prices higher, then you're shelling out everything for rent. How do you save for the down payment that you need? This is me projecting. I'm doomed.
You're not alone.
Doomed. Well, Bramwell's doomed.
Why isn't this the debate they're having on the debate stage for the Republican Party?
You'd hope so, except everybody's raising their hands. What would you do about Taiwan and that? You know, this is what matters.
And Trump.
Absolutely. And Karen coming up from New York. This is Bloomberg.
As we look out 3 years, We will have seen peak inflation. We will have seen peak Fed. Valuation levels will be more reasonable. Maybe we get a change in leadership in Washington with better fiscal policy approach. All of that suggests that stocks 3 years from now are going to be in much better shape.
That's the 3-year look. Phil Orlando, Chief Equity Market Strategist over at Federated Hermes. Let's take a 5-minute look at things right now. A 60-second look. Your equity market on the S&P 500. Negative here by 0.03%. This is a flat market after a 2-day winner streak on the S&P. In the bond market, yields just a little bit higher. But no drama here, Tom, on a 10-year, 421.58. The drama at the moment for the month of August preserved, seemingly for one nation, morning after morning, and that's been China.
It is China. There's no question about it. That's been the entertainment here, and it's a nuanced entertainment of international dynamics with the Secretary of Commerce visiting with Ambassador Burns. And far more than that, John, it's about the domestic discussion, which I would say is opaque and is, I think, maybe unknown, captures it. What's going on in Chengdu?
This line captures it from the Commerce Secretary, Gina Raimondo, that she hears from businesses that China is, quote, uninvestable. And we've heard that from market participants as well.
Yeah.
They've been stung over the last couple of years, Tom, burnt by some of the policies out of China. And now they're trying to encourage those same people back in to this situation.
My own predilection, all the back and forth, export, imports, and the confusing language of that's a single thing I look at, John, is what is foreign direct investment, FDI, what is it into China?
Yeah.
And it seems to have changed, and then it migrates over, Kaylee, say, to Vietnam or Indonesia, whatever.
Well, and that's what we're hearing about from the Commerce Secretary. She's speaking with reporters after meetings there. She said, let's see China act to attract more FDI. China said they wanted to open up their markets to the rest of the world. But to this exact point, some of the policies aren't necessarily rest of the world friendly. And Raimondo's raising things like IP theft, fines, anti-spy law, that these are some of the challenges that U.S. businesses in trying to deal with China are facing.
Is that intelligent debate derailed with a balloon that dropped into the Atlantic Ocean off the shores of the Carolinas?
That's the stuff that confuses me, Tom, because that stuff's been going on for ages.
We just knew about it.
We've only just found out about it. And Kaylee, that's what intrigues me about it. So meetings were always going to happen between US and Chinese officials. And then because we find out what's actually going on, they cancel the meetings. Really think that through. The United States government knew these things were happening, but we're still meeting with Chinese officials. Then the moment we find out about it, they cancel the meeting.
Yeah,
so how much of this is really about public consumption, Tom? How much of this is just about, look at us, we're doing hard things?
Yes, I'm as
opposed to actually doing
I'm as cynical as that.
Things.
And I think your point of why aren't the Chinese coming to America to be a valid point. Let's begin that conversation with most qualified at Bloomberg News, Enda Curran, truly qualified, a tour of duty in Hong Kong during the pandemic and now in Washington, our global economy correspondent. And I'm going to steal from John Ferro. Why aren't the Chinese coming to Washington?
So a couple of practical things there. There had been a ban on tour groups, the big tour groups leaving China. That was in place, I think, until recently. And also, of course, airline availability. The capacity hasn't been laid on for those routes out of China. So that means costs have been very expensive.
I don't mean guys coming in here to buy Gucci in New York. And I mean like Chinese officials like Secretary Raimondo. Are they welcome in Washington?
Well, there was one senior Chinese official did come here before the Blinken visit, if you remember, so there has been one. But yes, it does look like it's more of a conga line of US officials going in that direction rather than the other way around. I think that's why it will be interesting to see if A, we do start to see secretary-level Chinese officials come here over the coming months, but then B, just project forward to the APEC summit that the US will host on its own turf in November. President Xi, of course, will be at that. And that will be very interesting to see what kind of exchange President Xi will allow with President Biden on US soil.
And did you get the sense that President Xi cares about the state of the economy and financial markets when he makes these kind of trips? Is that important to him? Does he want to make those kind of trips with a strong economy and a buoyant equity market behind him?
I think, of course, it's paramount to the whole raison d'etre of the Communist Party. They want a strong economy. They do want a strong jobs market. They want strong foreign investment, but obviously they want it on their terms. I mean, we saw last week President Xi on the world stage pushing for and getting expansion of the BRICS bloc. Now, we can talk about that all day long, but the bottom line is it's pulled together some of the world's biggest emerging economies, broadly speaking, under China's influence. Now, whether or not the Chinese authorities are especially concerned about the go-go levels in the stock markets, I think that's probably more of an open question. but they do want a strong economy, and I think that's why we are seeing that tone change now on they're talking about doing more to attract foreign investment.
But Enda, things like cutting the stamp tax, limiting IPOs, in theory, that is targeted at financial markets. And then to your point, that isn't the only drip of information we've gotten from China or easing we've gotten from China. Now we have the news on potentially a cut to existing mortgage rates, deposit rate cut potentially coming from state-owned banks. It just seems like one thing after another. How much further can it go?
Yeah, look, a stock market rally doesn't necessarily reflect what's going on in the real economy. There's a big disconnect in China, but there's no doubt that what you really need to look at is what's happening in the real estate sector. That's the core of what's happening in China's slowdown there. That's why we are seeing, as you mentioned, they're bringing down borrowing rates. They're talking about cutting stamp duty, taking other measures to promote home buying, home selling, that kind of thing. So that's like the ground zero of what's happening in China's economy. But you look at other parts of it, by the way, it's not as bad as you might think. Take a look at what's happening in iron ore prices. Iron ore exporters and manufacturers are saying demand to China is holding up much better than expected. So that's why there's this open question, I think, going around about China this year. Are we looking at the annual China crisis, or is this something different?
If it were something different, though, what realistically is it that we're looking at?
I think the difference this time is as John just asked about there, it's the political backdrop. You know, what is the priority of the government? I mean, there's a benign interpretation that they're pursuing tough medicine for China's economy. They do not want to go down the road of debt again, given debt levels are already so high for local governments in particular. They know they need to straighten out the real estate sector. These are things, by the way, the international community have called on for years. So that's a benign interpretation, tough love. Of course, then there's a political interpretation, which is that the authorities aren't really that focused on, we'll say, juicing growth anymore. Their priority is ideology.
And with great respect for your service through the pandemic, Chengdu, 15 million people. Chongqing, I'm butchering these pronouncers, people, I'm sorry. 12 million. Wuhan, of the pandemic, 9 million. Shenyang, 7 million. We never talk about these cities. Are they flat on their back?
Well, the real estate side of things is pretty flat on their back in a lot of these cities, Tom. I mean, we've been reporting that housing demand is weak, house prices are falling, house sales are weak, housing developments are going unfinished. We know in the credit market, some of those big developers are either asking for grace periods to repay their loans, or they're seeing their bonds in secondary trade fall through the floor. So all of that ripples down to what's going on in the real estate sector of these provincial cities that you're speaking about. And then beyond that, we know there's a spillover on consumers. But what I'm saying to you is some parts of the economy aren't in the doldrums as the way the popular narrative might suggest. And I'm seeing some analysts make the point that take a look at what's going on in iron ore. It does show there's activity happening, especially on the infrastructure side of things.
Chris Verone said exactly the same thing in the last couple of hours. And let's finish here just briefly. You know this stuff inside out far better than I do. What are you focused on now? What are you anticipating is going to be the next move, given the moves we've already seen over the last couple of weeks?
Just keep an eye on what does happen with these property developers. I mean, we've seen this before. The plot spoiler might be that there won't be a kind of a Lehman-style moment. There'll be some kind of a bailout and everything will shuffle along. Just see what kind of tonic they do take to the real estate sector, how they navigate this kind of a hard landing that's going on at the moment. Or do they step back and put their hands up and really come to the rescue with the kind of flood of liquidity that we kind of got used to in China cycles past? All about the real estate sector and how the officials respond, John.
And thank you, sir, for the update down in Washington, D.C. and the current there. Tom, off the back of a range of policy moves, actions from the Chinese government over the last month.
So what's the big action they can do?
The big ask is on the fiscal side.
Mm-hmm. Yeah. Okay, but what about the political side? They got through the party Congress. She's been anointed to be, there for 40 years or whatever it is. What's he do if he has to change the dialogue? I think it's a complete mystery.
So I'm with you, which is why I asked the question. On the international stage for the BRICS summit, for instance, there was a feeling that market and the reporting that we'd done, asking some funds to come in and not sell more than they buy, was about just improving the optics for a visit for President Xi. And I just wonder, Tom, how that plays out later this year.
We had
but these are short-term fixes, let's be clear.
We had the discussion with the South African central banker, Jackson Hole. I think they're part of that BRICS dialogue, and I thought it was flimsy is the word I'd use.
The opening bell an hour away on Bloomberg TV. Great lineup. Michael Contopoulos of Richard Bernstein, Luke Hickmore of Aberdeen, Amy Will Silverman of RBC Capital Markets. From New York, this is Bloomberg.
Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Lisa Abramowicz off. She was in Norway last I heard looking at polar bears on their way to Greenland. I think she moved over a couple longitudes.
They have polar bears in Norway?
No, I don't think so, but she was on her way to Greenland where they have polar bears, I think. She's not in Iceland. Somebody said, is she in Reykjavik? And I said, no, I think she's somewhere north of Canada, somewhere where the, outdoors girl and all that thing. Kayla Line's with us this morning here, and Michael McKee joining us before Dr. at Bryson. What we're going to do is change things around here. Big labor week, but there's a lot of other stuff going on as well. Mike McKee, our theme today has been the shock of housing and rent in America. Owner's equivalent rent off the pandemic moving average is up 132%. We have vaulted from 3.x% up to 7.7% on owner's equivalent rent. That can't go on, can it?
Well, it can, but it's starting to fade because the data you're talking about is basically based on prices about a year ago. So what we're seeing is inflation in those numbers in owner's equivalent rent that is starting to back off, and that should have an impact on overall PCE and CPI for a while. And then it'll come back up because prices have gone back up. The problem is in this case, it's all based on the supply shortage of homes. Nobody's selling their houses because they're locked into low mortgages.
So today we have Case Shiller, 20 cities is the blending. Do you aggregate housing data, or do you have to look at the insanity of Washington, New York, Boston, and a few other geographies versus the rest of America not seeing those surges?
Well, for the most part, you want to disaggregate and look at individual markets because real estate is an individual market. However, a lot of us said that back in 2007 and 2008 and found that we can have a national impact. I don't think there's one coming here. That was based on housing loans as opposed to housing prices. But yes, we do have differences between cities in terms of what the prices are going to be because of demand again.
On the subject of prices, we're going to get some more specific data on those generally in the U.S. economy tomorrow. You get the GDP price index, and then, of course, PCE is coming as well, the deflator coming later on this week. Is that the data that's going to be primarily important to the Federal Reserve, aside from the jobs figures that we're getting throughout the week?
Yeah, and it may be more important in a way. The jobs figures are expected to show a decline in job creation, which is what you would expect and what the Fed has been waiting for. Even if we don't get a big increase in the unemployment rate, we should be hiring fewer people. We should have filled up many of the jobs. We get jolts today, by the way, at 10 o'clock. But the PCE is what the Fed looks at for inflation, and in particular the core. They target the headline rate, but the core rate is expected to rise a little bit in the month of July, to have risen in the month of July. And that may be a little bit of a concern, although some of that is base effects. The Fed's going to look at the numbers for PCE very closely because they want to know what's happening with inflation. Are we seeing sequential gains? And so in this case, even if the numbers come in, the headline numbers come in a little bit higher, they're going to break it down and look at the various categories, including housing, which is a smaller part of the PCE than it is in the CPI.
So on this idea of sequential, of seeing multiple pieces of evidence that are all contributing to the same narrative, the same story, and inflation pressure is easing, what is sufficient? Do we have a real understanding of for how long the Fed needs to see that before it decides, all right,
I asked that of a lot of people out in Jackson Hole, and nobody really has a good answer. They sort of say, we'll know it when we see it. I think if you get below 3%, the Fed is going to start to think they are on their way. And if we see a significant number of months where the monthly change is within acceptable bounds, which it has been lately at a 0.2% increase.
Quickly, Mike, does the Fed look at the visible nominal rate, or do they look at the inflation-adjusted real rate? Which one is it?
Well, they're looking at the inflation-adjusted real rate because it's of its impact on what financial conditions are. But they're looking at the overall rate to see what's happening with the economy.
We dive in tomorrow with Michael McKee, providing leadership on our labor economy here. Claims on Thursday, ADP, I believe, tomorrow, if it matters, and then on to an important jobs report before Labor Day. What a joy to get a brief summary from Jay Bryson, chief economist at Wells Fargo. I love, Jay, the two sentences in your report on a real yield, an inflation-adjusted 10-year yield that will, quote, drift through 2%. What's the ramification to our viewers and listeners of a 2.1 or a 2.2% real rate?
Well, so I think the ramification is that exerts significant headwinds on the U.S. economy. I mean, what you look at with the real rate, and Mike was kind of talking about this before, is that's what matters for the real U.S. economy. And if the potential growth rate of the U.S. economy, no one really knows exactly where that is, but let's call it roughly 2%. I mean, you kind of want a real Fed funds rate, at that or maybe even a little bit below. That would be neutral. You get north of 2%, then you're putting some real restraint on the economy. Whether it's enough to actually cause, a technical downturn, technical recession, right, that kind of remains to be seen. But even if it's not enough, it certainly puts headwinds on the economy. It slows growth in the U.S. economy.
I mean, Jay, I've got a Bloomberg Financial Conditions Index. A positive 0.31. Folks, all you need to know in the mathiness of it is it screams accommodation to me. How many rate rises do we need to get truly restrictive?
Well, so Tom, the index that you're referring to, and just for your viewers, it comes up with there's 10 different variables beneath it, okay? And one would be credit spreads on corporate bonds, one would be volatility in markets, things of that nature. Those are the big sort of things. And so how do you get it more restrictive? I guess it would be if the Fed were to become really more hawkish here. And so you start to price in some more rate hikes in there. That leads to volatility in the stock market. That pushes bond spreads wider. All those things really matter for the real economy as well. And right now, markets have been, I would say, very accommodative recently. Bond spreads have narrowed. Mm-hmm. The stock market's holding in there. But if we get, let's say we get a bad PCE print, tomorrow, or a really strong labor market number, and people start to believe, okay, there's even more tightening coming in there. You'll start to see that tightening in terms of the financial markets.
But the question is, when that tightening will come, even if we do get those things this week, if we get a blowout jobs report, if there's more inflation pressure than perhaps the Fed would like to see, would that actually result in a hike in September? We were discussing earlier how the bar for next month seems quite high. Would they still not pause, wait to see the lagged effects perhaps kicking in more, then make a call on November?
Yeah, Kelly, we agree with your sentiment there. I mean, I think that, as you said, the bar for a rate hike in September, I think, is pretty high at this point. I think, my sense is where the consensus on the FOMC is right now is we want to see a little bit more data. And so if you do get a blowout jobs report, if you do get a bad PCE print, I think what happens in terms of markets is that pushes the probability of a rate hike in November up. But that would also, I think, lead to some volatility in markets.
Jay, a question with immense respect for what Wells Fargo's done on labor economics for decades. Is our job market countable, or are we going to be surprised every jobs day forever, where we really, guys like you sort of don't, in your great team, don't really have a handle on the countability of the two surveys?
Well, so, when we look at our model, we look at the error bands around that. Our estimate, the error bands around our estimates are, somewhere like plus or minus 70,000. So, in some sense, you are throwing a little bit of a dart with that, and then that gets magnified in terms of the pandemic, because that just puts so much volatility into the underlying numbers that you're using to try to come up with a prediction. So, as the pandemic stuff starts to fade away over time, I think those error bands will start to narrow. But it's always, at the end of the day, a little bit of a guessing game as it relates to the labor market.
Yeah. And as it relates to, the headline figures on non-farm payrolls. But when we think about some of the other components of the labor market data, specifically the upward pressure perhaps on wages. We were speaking with Citi earlier on in the show about what we're seeing in terms of strike activity and union activity and the power of labor in pushing for higher compensation. How should we be thinking about that and how it relates to the Fed's fight against inflation?
So you get a lot of headlines in terms of, unions and things of that nature. I want to say that, I don't remember the number off the top of my head, but I want to say the percent of the labor force that's unionized today is only like 6%. I mean, we're not talking the 1950s or 1960s here. It's a much smaller sort of piece of that. And so it's, it gets a lot of headlines, but at the end of the day, it's a marginal sort of effect in terms of wages.
And sorry to interrupt, but the thesis, the thinking from Citi says that this is more just an indication of the supply problems we are still seeing in labor, which is why workers feel empowered to ask for more. And in theory, that goes beyond unions.
Yeah, that's a good point. I mean, obviously the labor market is very, very tight right now. To push for higher wage gains, it's easier when you are unionized, when you have collective bargaining, than if you're just out there independently doing it. But the point is that the labor market is tight. But anything that we've seen right now, whether you're looking at the ECI, whether you're looking at the employment cost index, whether you're looking at average hourly earnings, all of those things show there has been some deceleration in terms of wages. Now, we're probably still above where we need to be consistent with a 2% inflation rate. But that said, we're not getting the same sort of upward pressure on wages that we were, say, last year at this time.
Jay, personal income, personal spending, are they acting in a normal way?
Personal, yes. I mean, given as tight as the labor market is right now, personal income is acting in the normal way. If you look at the last, I don't know, 10 out of 11 months, we've had positive real disposable income growth because wages are growing faster than what prices are going up right now.
Jay Bryson, thank you so much. Dr. Bryson is with Wells Fargo. Great summary there of our economic data. Kaylee, I've had a huge response to our discussion of housing and rental today. And I think one of the answers here, which is something we've lived in New England and New York City as well, is move. And you just aren't going to live anywhere in the country. It's not, it's like what we saw in Jackson Hole. They live in Idaho Falls. They go through the Tetons if there's no snow and they live away. Woodbridge, Virginia, which is like halfway to the Carolinas. It's like an hour commute. They're dreaming. It's probably a lot more than that. It's 23 miles southwest of Washington.
Rush hour?
But that's it's not I'm going to suggest it's not 57 minutes.
No, I would guess it could be a whole lot longer than that. And this is the conundrum for a city dweller, city worker like me. Do you go for the 3-hour round trip commute every day to get more house?
Well, we'll have to see. Futures deteriorate. We got to go over the data here. S&P futures at -5, down 0.1%. This is Bloomberg Surveillance. Kaylee Lyons in for Lisa Abramowicz. John Ferro preparing for a momentous 9 o'clock hour. Kaylee, I look at the data, and I would suggest there's been a shift in the last half hour. Yields are up 5.03%. On the 2-year, the 10-year, 4.22%. Even the real yield gives me a pop up small moves, 1.92% on the 10-year yield. But more than anything, I'm looking at a resilient dollar, given all that's going on.
Well, and to that point, Tom, dollar-yen, 147.18.
Oh, there it is. Thank you. I missed that. Wow, 147.19, folks. 145, 46, 47 is a weaker yen, and we are, I will suggest quickly, that we're at a BOJ MOF watch here for intervention into their morning.
Well, when you're looking at levels, the highest we've seen since back in November of last year, that would maybe suggest that, Tom. And of course, you have the research of the likes of Goldman Sachs with a 155 view. What does the BOJ do then? How do you track that with what they're trying to achieve in the JGB market? Yeah,
we have an article out of Toru Fujioka out of the Tokyo office with Emi Arabi, and they make clear that there's a raging discussion of, quote, scrapping YCC. This is the short-term yield control of the central bank, which to a person in Jackson Hole they said was a fiction. We didn't get that from Governor Ueda.
Yeah.
That's all you got to say because you're thinking about Woodbridge, Virginia?
Yeah, exactly. I'm thinking about my housing doom. It's very distracting.
A huge response to that. Thank you for your emails. What we've seen on Twitter here on America's housing crisis. I think crisis actually captures it well. Futures -4. Stay with us. This is Bloomberg Surveillance. Out of last week, we have markets on the move. It's sort of a shock here. Up Friday, up Monday. We were up Tuesday, now flat on the market. Futures -4, but the VIX says all 15.19 is more than constructive, and that's made up from the August movers. Here's Kaylee Lines.
Yeah, we got some earnings movers still going, Tom, even as the season largely is wound down. Best Buy, one of the retailers, reporting this morning, the shares are up about 2.6%. They are talking about a bottom in that tech demand this year. They think the picture is going to improve going forward. More people like Tom Keene going out to upgrade their TVs. That stock up 2.6% as a result. Then another one that has really captured my attention, VinFast. This is a Vietnamese EV startup. It just went public in a SPAC listing a few weeks ago on August 15th. Since then, it's up something like 700%.
Come on.
This is
Are
one of those
SPACs still
wild
breathing?
movers.
SPACs are still alive.
Evidently so. But what we're writing about is how this is kind of evoking memories of other crashes we've seen in stocks that have moved this way. And maybe you're starting to see that showing up this morning with the stock down roughly 13% in pre-market trading. And the final one I wanted to mention, Tom, Zion's, of course, one of those regional bank players, down about 3.5%. We are expecting just over an hour from now, 10 a.m. Eastern time, the FDIC is going to be having an open meeting. They're likely going to propose requiring that banks with $100 billion in assets or more issue enough long-term debt to cover capital losses as we continue to see the regulatory response to the failures.
Now, they came off the bottom. I mean, Zion's from 70 down to 25 in the agony of this year. And they bounced up near 40, now 34.90. You've got them under 34 there. Kaylee, I did a lot of research on Zion's out in Jackson Hole, Western Bank.
There you go.
Came out of the $1 Million Cowboy Bar, and you look to the right, and just around the corner,
there's a branch.
There's a branch.
Yeah. Do you take
did
your
a lot
GNT
of research
in there?
there? Yeah, I just, careful study.
Yeah.
You go across the ways of park, and they got this arc of elk antlers. And I could see that as an art display inside our food court. It's like 15 feet tall.
Wow. Taller than Tom Keene.
Oh, yeah, wait, it's ginormous. It's ginormous there in Jackson, Wyoming, the home of Zion's Bank. We'll look for that today. This is a joy on your biggest headache, besides what we've said on housing and all today, and that is never and always airlines. Sheila Kahiyuju joins us right now, Senior Equity Research Analyst at Jefferies, and once she dabbled in leverage finance, so she's got a really twisted financial understanding of this crazy business. Sheila, my arch question is, do you change what is the behavior of senior managers? Are the senior managers now at United, Delta, Southwest, all of them, are they not like 1 or 2 generations ago where they're actually going to deliver a more persistent free cash flow?
Thanks, Tom. You give me a lot of credit. At Jefferies, I focus on equity coverage, covering aerospace, defense, and airlines. So I get the benefit of covering, 3 segments of the market. And we're quite negative on the airlines, just having our other coverage with the OEMs, mainly because of pricing and what we're seeing the low-cost carriers doing. But we do think the network carriers are better positioned, like the Deltas and the Uniteds of the world, that are getting that premium customer base versus the network carriers, versus the low-cost carriers that might see a little bit more pricing softness potentially as people's pockets move.
Okay, so to that point, if we're starting to see a little bit of a deterioration in the pricing power of some of these airlines, is that to suggest that travel demand post-summer, now that it's winding down, isn't going to look as great?
I think that's the question. I don't think, first of all, I think corporate is stagnating at 85%, 90%, and some of the meetings are getting replaced by Zoom permanently. So we haven't seen corporate improve. And across the airlines, nobody's really calling for a massive improvement here. International has been recovering and is doing really well. And that's where we're seeing the pricing momentum. And that's why United and Delta are really benefiting, prices up 25% plus. On the U.S. domestic side, U.S. domestic flights are still up year over year, but down 10% below 2019 levels. And we're seeing pricing stagnate there. So is the wallet moving to international, or are we seeing some customer softness there? That's the question that remains to be seen for 2024. But despite that, a few weeks ago, we downgraded Southwest Airlines to an underperform rating, first underperform on the stock. basically because we think that they have to change their network. They announced a $500 million network optimization plan that's going to go through the first half of next year.
Okay, so if we're talking about some of that pricing power going away, the pricing not being as strong on the input kind of side, then it's also the question of output and cost, especially in light of the deal, for example, American agreed to with its pilots, some of the cost pressures on the labor side. Also what we're seeing in terms of energy and fuel costs. What's going to happen to the profitability of these airlines if they have those two dynamics happening simultaneously?
I think that's the concern here. How much does the profitability shrink? If pricing is going down, fuel's going up, salaries are going up. American 2 weeks ago announced that, their pilot agreement, they didn't change their full year guidance because they took down some other expenses, and they were pretty ambiguous on what those other expenses were. So how does that now affect 2024 costs? And how does that shrink the margin profile of these airlines? And that's really why we're negative on the sector, as we think, pricing, although 15% above 2019 levels, probably stagnates here. Right. We'll see what international pricing does next year, but we don't think domestic improves.
Hey, Sheila, the airplanes are packed. That's my amateur observation. They're absolutely ridiculously packed. Every seat's taken, it seems. I remember when they were 74, 76% capacity. And yet I keep getting emails telling me that they're putting on flights internationally and particularly across the Pacific. Are those planes going to be full? Are those proven add-ons?
So I think that's where you're seeing the issue. Load factors is what we call them. They, like you said, Tom, they used to be normalized in the high 70s, and now the high 80s are the new normal. But Southwest saw 83%, I believe, in the second quarter, which was relatively low for the highest travel season. So it depends. It's on certain markets. One of the examples they cited is certain cities in the U.S., they're more work from home. So you don't need that necessary connecting flight to a major hub. So that's where you're seeing the softness. But I think international demand and capacity is still well below 2019 levels. International capacity, and that's driving the demand and the pricing there.
I don't know if you've seen this story, Sheila, but Alex Milson here for Bloomberg with the only story that matters today. There's going to be an adult and child section on airplanes. You got to be kidding me, Sheila. LaGuardia to DFW, there's going to be a children's section on the airline.
I must have missed it.
Okay, Sheila, here's your context. This is one European airline, Corendon Airlines, is going to pilot a no-kid area on a 10-hour flight just between Amsterdam and Curacao. You can pay $49 to sit in the exclusive adult-only zone.
What do you think, Sheila?
I didn't know that was a coveted route that needed a specialized, section, but good for them if they think that's a niche market.
Sheila, thank you. Sheila Kealu with us, with Jeffries here on the aviation business. Have the fares come down? I believe I haven't noticed that. I guess they've come down a little.
Yeah, but coming down from very high levels, which is the problem with prices all over, everywhere you look.
And I wanted the wiggle room here. I mean, we just did, Francine had the Gulfstream, and so we were all on regular flights. And I was on 4 flights. There were no empty seats.
Packed.
None. Zero.
My flight up here, completely full.
Completely full. And this is a whole new world after all.
And then it got canceled.
I remember talking to Robert Crandall, who, invented all this with American Airlines years ago. And he said, these guys have a new changed religion. And he said the managers of Delta and United and the rest really want to keep the gravy train going. And I guess that's how you do it. You don't put on airlines.
Yeah. Well, there's also the question, which they've received a lot of political backlash for, delays, cancellations, having to refund customers in more instances when they face those kind of issues. You have no idea how hard it was for me to get up here and join you on this show.
I know.
DC to New York.
Well, you got to get the surveillance
Short
Bentley
trip.
and just cruise up. You can drive up and it's
all right. I'll talk to management about that.
We're going to talk to the data today, and I'm going to go to something that Chris Verone brought up. I got 85.00 on oil. We began Bloomberg Surveillance today, Kaylee, with Chris Verone saying oil higher. And that really gets my attention in the quiet. $85 even on Brent crude.
Yeah, and he was saying 90 looks like it could be realistic. And from a Washington perspective, how does that translate into prices at the pump?
Which could translate into the election
exactly.
season as well. Are you going to be here tomorrow?
I will be.
Are we enjoying this? You're not going to leave in a tantrum or anything?
No, I'm just leaving you for Jobs Day.
Okay. Well, yeah, we'll try to stagger forward on Jobs Day. Another number we haven't talked about today, the 3-month T-bill off your money market fund, 5.44%. Bloomberg surveillance on radio, on TV. Good morning.